Trading is quickly becoming one of the most important skills for you to learn. If you're a struggling trader trying to find a strategy and trying to get profitable, you need to watch this video. I have built a 5-hour mastermind just for you, completely free, showing you exactly how I trade on a daily basis. This video is a culmination of that entire strategy spread over the course of 5 hours. Take as long as you need to watch this video. Like and subscribe, and I hope this brings you value. Most beginner traders struggle because they do not understand what liquidity is. So we're going to be starting off by learning liquidity. Just the basic stuff. What is liquidity? Liquidity is the foundation of institutional trading. It's the whole idea of price. Write this down, okay? Price does two things, and I want you to write this down. One, it seeks liquidity. And two, it seeks to offer fair value. Write those two things down because that is the whole idea of price action. That is the only way price moves. It seeks liquidity and seeks to offer fair value. Write that down. If you're not going to write anything down, make sure you write that down because that is the most important part of this whole concept. Price moves to seek liquidity and offer fair value. And we like price forming fair value gaps because it gives us an idea of where price is going to retrace to. And that's going to make more sense later on. But let's get straight into it. So what is liquidity? Very, very basic. Liquidity is areas where clusters of orders rest. So that is stop losses and buy or sell orders. Let's show an example. So we have these highs and lows. Every single high and low is liquidity. Every single one. There's liquidity here. There's liquidity here. Down here. Down here. Every single high and low you see, this one, and even the highs and lows of candles as well, which we'll get into soon. But really, you want to be looking at the overall range on this. So every single move, even in like a very small retracement like we have right over here, this one here, there's highs and lows. Here's liquidity over here and liquidity down here as well. You can see we take this high out, which was liquidity, which was a liquidity sweep, which we're going to be moving on to soon. But that is what liquidity is. Liquidity is areas where orders rest. So you can see here where people have started to enter their sell entries. Price pushes, that pushes price down because more people are selling, leaving behind liquidity because that is where there are resting orders. And these can come in the form of entries and exits in the form of stop losses. So if you're getting in for a sell position, let's say you got in for a sell position inside of this candle, where you would look to put your stop loss, or where retail traders would look to put their stop loss, is simply just above this move. And you can see price comes back to that to take out all of those stop losses, which then generates enough liquidity to then actually fuel the move down. And that's how it works every single time. Why does it do that? Because price seeks liquidity and seeks to offer fair value. Hey Gustavo, nice to see you here. And yes, Hannah, that is correct. 1, price seeks liquidity, and 2, offers fair value. That's it. Every single time, every single move is either towards liquidity or to offer fair value. And that is it. Now, that is what liquidity sweeps are, or that's what liquidity is. It is buy-side liquidity, There's two types of liquidity. There's buy-side liquidity, which is highs, and sell-side liquidity, which is lows. As I've just shown you, every single high and low is liquidity. So what would this be? If buy-side liquidity is all the highs and this is the high, what would this be? Would this be buy-side liquidity or sell-side liquidity? Answer that question in the chat, guys. Is that buy-side or is that sell-side liquidity? Exactly. Buy-side liquidity. Exactly, guys. Buy-side liquidity. Exactly. Perfect. So we know that the highs are buy-side liquidity, which means what is this over here? Is this buy-side liquidity or is this a sell-side liquidity? exactly. Sell side liquidity. Perfect, guys. You're 2 for 2 at the moment. You got buy side liquidity. You got that perfect. And sell side liquidity. Perfect. Exactly, guys. Nice work, Gustavo. That's what buy side and sell side liquidity is. It is highs and lows. I just wanted to make sure everybody knew that. We're all on the same page, and clearly we are. Every person has said sell side liquidity. That's great to see, guys. So that's what liquidity is. It's buy side liquidity and sell side liquidity. Buy side liquidity is highs, as you guys know, and sell side liquidity is lows. Now, institutions and institutional traders like big banks, think of JP Morgan, HSBC, Barclays, there's a few others, but they're the main big ones. Those guys are the institutional traders in this example. They are the institutions, and what they will do is target liquidity so that they can then fill their massive position. And that's going to make a little bit more sense when we move on to what exactly AMD is and how to use that with liquidity. But let's move on. We know exactly what liquidity is now, guys. So now we know what liquidity is. We need to look at liquidity pools and stop hunts, okay? So here's an example, or here's a chart that I was going to show you an example of, but we do not need to use that anymore. Now all we need to focus on is liquidity sweeps and reversals, okay? Let me show you exactly how that works, guys. So what price does, exactly what I said, it does two things, doesn't it? One, it seeks liquidity. And two, seeks to offer fair value. Yeah? We're going to keep on referring back to this, guys. So it's very, very important you know this basic concept. Price seeks liquidity and seeks to offer fair value. Now we apply this. We just want to focus on step one at the moment. So we just want to focus on seeking liquidity. We don't need to look at offering fair value at the moment. We just want to focus on the part one, which is seeking liquidity. Price seeks liquidity, okay? Now, if you don't have this tool yet, what I want you to do is either write it down or, get it at some point. All you need to do is go to the left-hand side over here, hover over the second option, which is Trendline Tools. Hover over Trendline and click the star next to it, and then you'll have this widget appear with the trendline on it. And we want to use that for liquidity, okay? So to mark out liquidity, what do? You go back to a previous high, like this one over here, draw above it, and it's to the wick, guys. You draw above it with that trend line. Then you go to settings, and I want you to go to text and put the $sign in. You can put it in once, twice, put a $sign there to show liquidity. And that's exactly what I've done there. So click template once you've done that, save as, and there you go. That's your liquidity. Now that that's out the way, we can draw this every single time we see liquidity. And what's liquidity? Highs and lows. So here we have a high, as you can see. So what happens here is people will then enter their sell position to push price down, and they'll also see prices going down and get in. And that's what creates a fair value gap, but we'll get into that soon. All you need to understand is this area over here, before we started moving down, is where obviously someone got in for a sell position. They either sold their buy position or entered a sell position. And if they've entered a sell position, where are they going to put their stop loss? Most people would put their stop loss just above this high, and that's because that's just the rule of thumb that people get taught as a beginner trader. And that's what we're going to be avoiding, and I'm going to teach you how to avoid that today. But this is how it works. So we have this price up here, like 196. Then price reverses and heads down, leaving behind this high. People see prices going down, and people also have an analysis that makes them assume price is going to go down, whether it be, this fair value gap over here, or, a Fibonacci, whatever it is, they have some form of analysis which makes them think it's going to go down. So there's a lot of sell entries here, and you can see that in the pressure of these two candles, we push straight down very quickly. We're going to get in more in depth into what that actually is and how that works soon. But for now, all we need to understand is that price melted to the downside right after forming this high. So there's liquidity resting above here because people have entered their sell position, obviously, and most of them people have put their stop losses literally just above the high. Like it might be right here, it might be here, it might be here. It's a general area, but this is where there's going to be liquidity resting, okay? So what happens is we have this move down. Some people may have took profits, which is what led to this move up, or the institutions, as I said, like JP Morgan, the big banks, all of those guys have basically pushed price up to generate enough liquidity to then fill their massive position to then give us this massive move to the downside. That's exactly how it works, guys. we have this liquidity here. Like, we may not get a move like this big every single time, no, but we always will get a retracement after taking a high or a low. So if we take a high out, we retrace down. Okay, that's just the way it is, because it's usually a manipulation to take the liquidity. And if we take a low out, we then retrace eventually and come back up to form a high. And that's how general price action works. It's lower lows, lower highs, and higher lows. Here it's a higher high, then a lower low, which will make a little bit more sense soon, but for some people they'll understand that's a change of character. But what I want you to focus on is the fact that orders were placed here with stop losses just above this price. Price comes up, takes out those stop losses, and then we have the real move down. Why does it do that? Because price always seeks liquidity. We even do it down here. There's even liquidity resting over here and over here as well. Let me just draw it out. There's even liquidity just resting here as well. So price comes down, price takes out this high, comes down, leaving behind orders up here, takes out this liquidity where there's also stop losses and pending orders. Those orders get executed, then price reverses, takes out this liquidity over here, then reverses again and heads all the way down. And that's as simple as it gets, guys. We're going to follow this through now and see how price action played out throughout this move down. So we take out this high over here, correct? Leaving behind this high over here, which is liquidity. And another thing to note, guys, as well, once we hit a liquidity zone, so once we take out this area over here with this candle, this is no longer a liquidity zone. There's no longer any liquidity here because it's all been taken out, because that's what that move up was for. It was to take out those stop losses, to activate those pending orders, to generate enough liquidity to actually fuel the move down. And that's going to make a little bit more sense when we talk about AMD. But what I want you to focus on is this entire move. So what's happened? We leave behind a high, we come down, take out the lows, because every single low is liquidity. As I said, every single low. So we have all of these lows here. We take out all of these lows in a move down. You can see we take out this low, retrace, then take out this low right here, retrace, take out the low again right here, retrace, leaving behind a lower high, by the way. Then we take out the lows again. We even take out this key low over here, which is a higher time frame low. Continue down, retrace, forming a a lower high, which is this low right here, which is this high right here, and a lower low, which is this low right here. Then we come down, take the low out again, and just continue that cycle until we reverse, and start pushing it back up a little tiny bit, where we take out this high, and then just form a lower high, a higher low, then take out the high again, and just continue price. That's literally all it does, guys, is take liquidity. It just seeks liquidity. That's what I want you to focus on there. You see that whole move down was just price taking lows, retracing, taking lows, retracing, and taking lows. That entire cycle, that's what that move down was. And the move up would be the exact same thing. It would be price taking highs, retracing, taking highs, retracing, taking highs, retracing, taking highs, retracing. And that is the trend. That is an uptrend where we have higher highs, which are these, where there's liquidity resting, and higher lows, which is these lows, where there is also liquidity resting. Okay, that's a very basic concept, and you need to understand this in order to understand how ERL and IRL works, which I'm going to show you in just a moment. But for now, I want you to focus on the fact that price just seeks liquidity. Just focus on price seeking liquidity. We have a low, we take it out. We have a low, we take it out. Leave behind a lower high, make a lower low, repeat that cycle until we change, until we reverse. And I'm going to show you exactly how to read price action. Like, you would look to take a sell right here. I'm going to show you exactly how to do that. Same here, same over here, and same over here. I'm going to show you exactly how to get into these trades at the perfect time. And at the end of these 3 lectures, because bear in mind, this is lecture 1 of 3, you're going to completely understand exactly how to enter at the best possible time and not get caught in any stop hunts, which is like losing trades just to see it go in your direction anyway. But for now, as I said, focus on the liquidity. Price takes out a low, retraces, takes out a low, retraces, and so on and so forth. Okay, and that is what liquidity pools and stop hunts are. What liquidity pools are really. Now we're going to look at stop hunts. Okay, so what's a stop hunt? A stop hunt is manipulation, specifically in the form of AMD as well. But it's a manipulation to take out these stop losses in order to fill massive positions for the institutions. That's how it works. It's manipulation. Price is being manipulated to do something that it shouldn't really do. Okay? And I'm going to show you exactly how that works now. It comes in multiple forms. It's not as simple as you may think. Like, you might think that this high over here took out this high, and that's why it's the manipulation, but that is incorrect. It's very, very quick, and you'll find these stop hunts very, very close together to previous highs, okay? So, we have a high right here, okay? Yeah? We come down, okay. Now everyone enters their sell positions because we've just took out a high, and we're probably going to retrace now. We take out the high, come down, but then take out this low over here, flip, and come up and take this high out again before actually having that move to the downside, which we have over here, okay? Look at that. That's what you call a stop hunt. We take out a high, like a massive previous high from the left-hand side somewhere, okay? We then come up and take out that high again very, very quickly, and then continue the move down. Okay? Do you see that, guys? We take out this high here. We take out a high. We leave behind a new high. People are like, okay, we've just took out a high. Exactly how I shown you with that bearish trend where we came down, then retraced. People are looking to catch that retracement. So we just took out the high. Everyone's like, okay, well, we're probably going to start looking for sells now. They enter their sell positions. It goes nice, looks like it's going great. But then price flips, takes out this high again, which is where what? Rests, pending orders in the form of stop losses and, market executions like sell orders and buy orders. But specifically, we want to focus on OCO orders, which are stop losses and take profits. Stop losses are resting here, okay? Price takes that high out, and then fuels the actual move down, okay? So this is what that manipulation looks like. The same thing happens here on a lower time frame. If we zoom into these two candles right here, you can see the price forms a high on this candle, then takes out the high of that candle in the next candle, only to then actually have the move down. Price then takes out the low, comes up, takes out the high, comes down, takes out the low, comes back up in the stop hunt to take out these orders, then has a nice move to the downside with no manipulation. As you can see, we do not come back up anytime soon to take out this high that we left behind because there was no manipulation there. This was the manipulation, okay? Does that make sense, guys? Now I'm going to ask you a question, and I want you to reply with what you think the answer will be, okay? Just give me 1 second to set it up for you. So, we form a high here, okay? We form this high right here. I'm going to mark that out for you now. There's liquidity right here. Price comes down, then reverses and takes out the high. Now, I want you to answer this question in the chat, okay? Is this move up manipulation? Is this a stop hunt? Yes or no? Is this a stop hunt? Yes or no, guys? Okay. Okay. Exactly, guys. Yes, it is. Gustavo, you said no. Why was that? This was a stop hunt, guys. That is correct. You are all correct there. That is a stop hunt. You're free for free now, guys. I've asked you 3 questions and you got 3 of them right. Perfect. That is a stop hunt. Classic example of a stop hunt. Price looks like it's going to go down, but then only reverses and heads up. And I'm going to show you exactly how to avoid this, because what we want to do is try and catch this move down, as Gustavo asked me, without looking or without becoming liquidity, okay? We want to catch the move down without becoming liquidity. And a lot of people will probably see how this makes sense, but this will make sense to everyone in this chat or in this stream once I've explained ERL and IRL. But for now, all you need to understand that this was a manipulation, this was a stop loss hunt, and we want to know how to avoid that. How do we avoid becoming liquidity? Because we want to catch these moves, we want to catch this move to the downside, but we don't want to become liquidity. So we have 2 options. We can either get out before the reversal, which is very, very hard to do, or we can wait for the manipulation and then have the actual move, like this one right here. Okay, so that's what a stop hunt looks like, guys. Price comes down, reverses very, very quickly to take out the liquidity that it's just formed, which is a stop hunt, and then has the move. I'm going to show you exactly how to avoid becoming liquidity, and I'm going to show you exactly how to stop price hunting your stop loss, okay? Let's move on. So, liquidity as market fuel. Very, very simple concept. All you need to understand is that liquidity sweeps fuel, liquidity sweeps fuel market moves, okay? And that is how AMD works. I'm going to show you exactly what AMD is and how that works tomorrow. As I said, at the end of this free lecture program, you will know exactly how to trade like me. You're going to have a few questions left at the end of this stream, but I want you to take into account everything I'm teaching you right now. Make sure you're making notes. Make sure you're taking notes. And as I said, if there's any questions, ask me them at the end, and I will get back to every single question. Now, liquidity is what fuels the markets, okay? And this comes in the form of accumulation, manipulation, and distribution. What is AMD? What is AMD? Okay. AMD is 3 things. It is an accumulation. You've probably seen my video. It's an accumulation, manipulation, and distribution. Okay. Now you understand how stop loss hunts and liquidity works. This manipulation here takes out the highs. Yeah. Takes out the highs and then reverses and comes down. But how does this work? Why does it do this? We know that it does it. We know that price will manipulate to take stop losses, to activate pending orders, to fuel liquidity. We know price seeks liquidity, but why does it do that? Why? I'm going to show you why right now, okay? First things first, you need to understand that price or trading in general is a zero-sum game. Zero sum. Write this down too, guys. Trading is a zero-sum game. If you're making $500, there's a collection of $500 being lost. Okay? So if you're making $500, someone is losing $500. It is a zero-sum game. It has to come down to zero. Okay? What's plus 500 take away 500? 0. It's a zero-sum game. Okay? It's a very basic concept, but this you need to understand in order to understand how trading works. So, first of all, trading is a zero-sum game. Okay? Second of all, well, because it's a zero-sum game, there needs to be liquidity to fill positions. Okay? And if there's any crypto guys out there in this chat, you will understand how this works already, probably. Exit liquidity and entry liquidity. So for you to enter a position of, let's say we want to enter a position of 10 lots, yeah? 10 lots, pretty high. Let's say we want to enter a position of 10 lots. We want to 10 lots. We want to buy 10 lots, okay? We want to get into a buy position worth 10 lots, okay? There needs to be at least 10 lots being sold. Someone, think of it like the market, think of it like a shop. If you want to go out and buy a Lucozade, if you want to go out and buy a pack of Doritos from the shop, someone needs to be selling a packet of Doritos for you to buy it. If no one's selling any Doritos, you're not going to be able to buy any Doritos, are you? Think of it like that. If no one's selling Doritos, you can't buy Doritos. If no one's selling 10 lots, if 10 lots are not being sold, you cannot buy 10 lots. And it works the other way around as well. If you want to get in for a sell position and you want to sell 10 lots to someone needs to be willing to buy 10 lots off of you. Now, when you get in for a trade, it happens very, very quickly because there is lots and lots of volume in the markets, especially in Forex. It's the highest traded market in the world. If you're buying 10 lots, someone needs to be selling 10 lots to you. If you're selling 10 lots, someone needs to be buying 10 lots off of you. Simple business structure. Yeah? Supply and demand, basically. So, 1. Trading is a zero-sum game. If you're making $500, someone's losing $500, which equals 0. 2. There needs to be liquidity to fill positions. If you're buying 10 lots, someone needs to be selling 10 lots. Write this down. If you're buying 10 lots, someone needs to be selling 10 lots. And if you're selling 10 lots, someone needs to be buying 10 lots off of you. Now, in trading, in Forex specifically, it's very, very easy to get in for a position because there's just always enough liquidity for retail traders who only trade smaller lot sizes like this one. And there's no issue at all. But sometimes, and most of the time, there's not enough liquidity to fill a big bank's position. So, as I've just said, if you want to buy 10 lots, someone needs to be selling 10 lots. So let's say a big bank, let's say JP Morgan, we all know who that is, yeah? That bank, we all know what that bank is, JP Morgan. If they want to buy, let's say 10,000 lots, yeah? If they want to buy 10,000 lots, someone needs to be selling. Or there needs to be a collection. It doesn't have to be one person. It can be a collection. So I could sell 1,000, you could sell 1,000, someone else could sell 8,000, and that would equal 10,000. It doesn't have to be one person, but typically someone would have to be selling 10,000 lots. Think of it like this. You know how, let's say, Starbucks, yeah? Starbucks, yeah, can you all see that? Let's say they need to buy 10 billion cocoa beans, yeah? Or coffee beans. 10 billion coffee beans. Starbucks want to buy 10 billion coffee beans. If there's no one selling 10 billion coffee beans, or there's not 10 billion coffee beans being sold, they're not going to be able to buy 10,000 coffee beans, are they? Okay? And that was a random choice because I have a Starbucks right next to me. But it's exactly the same thing for everything. If I wanted to buy this deck of cards, someone has to be selling this deck of cards. If I wanted to buy this phone, someone, or Apple specifically here, had to be selling this phone in order for me to buy it. If I wanted to buy this watch right here, someone needed to be selling this watch. If I wanted to buy these AirPods, someone needed to be selling those AirPods to me. And it's, as I've just said, how it works for us, it works for them, because Forex is the same thing. If JP Morgan want to buy 10,000 lots, someone needs to be selling 10,000 lots. Okay? But this doesn't happen all the time. Barely ever there is just 10,000 lots sitting around ready to be sold. So when JP Morgan want to buy 10,000 lots, sometimes there is not 10,000 lots being sold. So they have to manipulate price to do this when there isn't enough liquidity institutions have to manipulate, remember that word from what we just spoke about, stop loss hunts? They have to manipulate price to generate enough liquidity. Okay, guys? So, let's recap. Trading is a zero-sum game. If you're making $500, someone is losing $500. Okay? That's rule number one. Rule number two, there needs to be liquidity to fill positions. If you're buying 10 lots, someone needs to be selling 10 lots. You know, if I want to buy this coffee, someone has to be selling this coffee or I won't be able to buy it. Apply that to trading and apply that to big banks with big, massive orders because they trade with billions and billions of dollars. If they want to buy 10,000 lots, someone would have to be selling 10,000 lots. But what happens when no one's selling 10,000 lots? Or there's not enough lots being sold for them to buy? They manipulate price to generate enough liquidity. And why do they do that? Because trading's a zero-sum game and there needs to be liquidity to fill positions, okay? Now that you understand that, we can look at AMD. But let's just draw this out again. So, let's just simplify it. JP Morgan want to buy 800 lots, okay? They want to buy 800 lots. We're going to put a B here for buy. They want to buy 800 lots. But there's only 600 being sold. We're going to put an S here for sold. S, B. Buy 800, sell 600. They want to buy 800 lots, but there's only 600 being sold. So what do? Because trading is a zero-sum game, and when you enter a buy position, to get out of it, you have to enter a sell position. Like, when we buy 10 lots, we have to then sell 10 lots to get out of that trade. When we sell 10 lots to take a short position, we then have to buy 10 lots to get out of that trade. So, they look and they can see footprints of where people have entered their trades and stuff like that, and they see that, you know, they know that we will put we will put stop loss above or below price if it's lows or highs. In this case, we're going to look at highs, okay? So let's say we're right here at the moment, yeah? We're right here. This is where price is at the moment. They want to buy 800 lots, but there's only 600 lots being sold. What will they do? They will push price down to take out this low over here, which then activates the stop loss of people who were already in a buy position. Because if you were to enter a buy position here, where would you put your stop loss? Just below the low. Yeah? Can we agree? You know? And it's not just one person, it's a bunch of orders all over here. Loads and loads and loads of orders of people entering buy positions and putting their stop loss below this low. So JP Morgan want to buy 800 lots, but there's only 600 lots being sold. So they target a low to generate enough selling liquidity, because two things will happen here. People will go, price has just formed a new low. I'm going to enter my sell position. Hooray. That generates selling liquidity. And then there's other people, when they see price taken out, you know, pushing up, they'll go, I'm going to enter a buy position and put my stop loss here. Price then comes down, takes out that stop loss in what we call a stop hunt, correct? Which generates enough selling liquidity. Let's say it hypothetically makes 200 lots being sold to then fill their massive position. So they want to buy 800 lots, okay? There wasn't enough there, so they generated liquidity. They manipulated price to generate liquidity, because there has to be enough liquidity in the markets. If you're buying 800, someone has to be selling 800. So they manipulate price to generate liquidity. So now we have 800 lots here being sold. Then they fill their position, and then we get the distribution move. Now let's go through that in the actual example that I've drawn here, okay? So price accumulates, which is a generation of liquidity because there's there's lows and highs here. We got liquidity resting at the highs and liquidity resting at the lows. Okay. JP Morgan want to take a massive sell position, but there's not enough liquidity in the markets for them to fill their position. So what do? They manipulate price to take out all this buying liquidity, buy-side liquidity, which generates short positions, basically. It's stop losses for people who are already selling, which is then a buy position, an OCO order. And then there's also people getting in for buys because they see prices breaking out. And this is what you call a fake out. Price then reverses and heads down because now there is enough liquidity for JP Morgan to enter their massive position, and price moves down. So price accumulates, manipulates to take out one side of liquidity to fill a massive position for an institutional trader like JP Morgan. Then because there's enough liquidity, they then activate their position. They get in for their position. In this case, it's a sell position. Then price moves down. Our job and what we want to do is catch this massive move down and avoid becoming liquidity. Okay? And at the end of this series, there's 3 lectures. At the end of this mini series, you're going to completely understand how to get into your positions without becoming liquidity and to catch this massive move to the downside. Now that I've shown you that now I've shown you that example, let's have a look on the charts, okay? So, I'm going to draw a box around this, and you guys are going to tell me what this is, okay? So, there's accumulation, manipulation, and distribution. We have liquidity on this side here, and we have liquidity over here as well, specifically in this low here, okay? So, price comes up to take out this high. What is this? Is this manipulation? Yes or no? Answer that in the chat, guys. Is this manipulation? Yes or no? This move up to take out the high, is it manipulation? Yes or no? This move up to take out this high, is it manipulation? Yes or no? Okay. Yes. Everyone who said manipulation was correct. That was manipulation. Price pushed up to take out this high to generate enough liquidity to then reverse and head to the downside. Now, if you look to the left-hand side, you will see a fair value gap. I don't expect you to understand this yet, but you can see a fair value gap very clearly there before the move down. We also have an IFVG formed right here, signaling the move down. And that is part of it, guys. This is part of how we catch these moves to the downside, or how we catch the distribution move. It's how we tell the end of the manipulation. And guys, I want to just show you something as well, very, very quickly. This is not a question. I'm just going to tell you the answer to this one. See how we had this high formed right here? And then we come and take out the high again. We move down, then come back up, take out the high again, and then move down. So I've shown you what liquidity is. I've shown you why it exists, why it has to work. I've shown you what it looks like. And now we need to understand how to actually get into that trade. How do we catch this move? How do we catch the big moves? And how do we avoid becoming liquidity? Here, we were able to spot the end of the manipulation. We were able to catch the start of the move, but a lot of people will still have become liquidity. And that's based on your stop loss placement, which we're going to get into very soon. But you guys were correct in saying this was a manipulation. That is 100% correct, because we came out and took one side of the accumulation range. We took out this high to generate enough liquidity to have them move to the downside. We can see what called the end of it. We could have just waited for price to come into this fair value gap, or waited for this IFVG to form, take your entry here, place your stop loss here, then take your entry wherever you want to go. But you see, price came straight back up and took out the high we literally just formed. That is a perfect example of a stop hunt. We had the manipulation. We had the whole idea of manipulation. We had the stop hunt as well. We then showed signs we were going to reverse, only for price to come straight back up, take out people's stop losses, and then get the massive move to the downside. That is a perfect A+ textbook example of AMD. And a stop hunt as well. Okay, now a few of you guys may not understand what fair value gaps are, and do not worry, don't stress. I'm going to show you exactly what they are and how to identify them very, very soon. All you need to understand from this point, this part of the lecture, is how AMD and liquidity work together. Price accumulates. Big banks want to enter massive positions, but there's not enough liquidity to get into those positions, is there? So they generate liquidity to get into their positions, just like this. What we want to do is be able to catch this massive move down. Yeah? How does that work? Well, you want to use liquidity and fair value gaps. Liquidity sweeps create fair value gaps, and we can also use fair value gaps to call the end of a liquidity sweep as well. Okay? But very, very quickly, we need to cover what a fair value gap is. Okay? I'm sure a lot of you know what a fair value gap is. This is going to be a very basic guide because, excuse me guys, I got a little bit of a cold. It is very, very simple. A fair value gap is made up of 3 candles, okay? And there are 2 types of fair value gaps, really. There's a bearish fair value gap and a bullish fair value gap, okay? I'm going to show you exactly what both of those things are very, very quickly, and then we're going to move on to how to use them with liquidity. So, what is a fair value gap? A fair value gap is made up of 3 candles. There's a bullish fair value gap and a bearish fair value gap. With a bullish fair value gap, we want to look to take buys off of it because it's bullish. And a bearish fair value gap, we want to look to take sells off of it because it's bearish. Simple stuff, guys. Now, what we want to look at inside of a fair value gap is the displacement candle, the candle that actually had the move, the candle that is the gap, basically the middle candle. So we have candle number 1, candle number 2, or the expansion candle, and then candle number 3 in every single fair value gap. Here we have a bullish example. We have candle 1, a bullish expansion, and candle number 3. Here we have a candle number 1, a bearish expansion, and candle number 3. That is what you will see in every single fair value gap. Every single fair value gap will have 3 candles, and you only really want to focus on the middle candle, okay? What determines a fair value gap to be bullish or bearish is simply just the middle candle. This candle over here could be bearish. This candle over here could be bullish, and we would still have a bullish fair value gap. This candle over here could be bearish or bullish. Let's see. Let's just draw this out so it makes a little bit more sense. This candle over here could be bullish or bearish. This candle could be bullish, and we would still have a fair value gap. You don't want to look at these candles. It does not matter on the first and the third candles direction. It does not matter. In a bullish fair value gap, it doesn't matter about the first and third candles direction. On a bearish fair value gap, it does not matter about the first and third candles direction. Okay? I just want to clear that up because a lot of people get confused and think it has to be 3 bullish candles or 3 bearish candles. The first and third candle of every single fair value gap does not matter. You don't need to look at it. It doesn't matter at all. Now, there is one little thing that you need to look at, and I'll show you exactly what that is in a second. But for now, all you need to understand is that a bullish candle is a middle candle that's bullish, and a bearish fair value gap is a bearish candle that's bullish. A bullish fair value gap is a bullish candle that's bullish, and a Bearish fair value gap is a middle candle that's bearish, okay? Does that make sense? Now, as I said, it does not matter about the first and third candle's direction. It does not matter. Don't look at it. All you need to focus on is the middle candle's direction. If the middle candle's bearish, bearish fair value gap. If the middle candle's bullish, bullish fair value gap. But what does matter is if the wicks overlap. Now, specifically, we're going to focus on a bullish fair value gap right now, okay? In a bullish fair value gap, you need to make sure that the top wick of the first candle doesn't overlap with the bottom wick of the third candle, okay? You want to see a fair value gap just like this. That's the gap. It doesn't matter about the direction of these candles. As long as the wicks do not overlap, you have a valid fair value gap. If the wicks look like this, and we have a massive wick here going all the way down, there is no gap here at all. There's no gap, so we don't draw any boxes. When there is a gap, you draw a box from wick to wick, just like this, okay? And that's what a fair value gap is. In a bearish fair value gap, it's the same thing. You just want to make sure that the wicks do not overlap, okay? As long as the wicks don't overlap, you have a valid fair value gap. So when you're spotting fair value gaps, you'll pick this up as you get used to it. But you'll look at the markets, you'll see, okay, well, there's this bullish candle and there's no wicks overlapping, so that is a clear bullish fair value gap. Oh, here's a bearish candle where the wicks don't overlap, so this is a valid bearish fair value gap. Simple as that, okay, guys? Now that that's out the way, I think that's everything for the fair value gaps. All you do is wait for price to come back into it and look to take buys or sells. If it's a bullish fair value gap, you wait for price to come back into it and look for buys. If it's a bearish fair value gap, you wait for price to come back into it and look for sells. Okay? Just like this. So what I want you to write down, okay? I want you to write this down, okay? 1. A fair value gap is 3 candles. First candle, expansion candle, third candle. Okay? 2. The direction of the first and third candle does not matter. All you need to focus on is the expansion candle. If you want, put in brackets, second candle. 4. If the expansion candle is bullish, the fair value gap is bullish. 5. If the expansion candle is bearish, the fair value gap is what? It's bearish. Okay? Very simple stuff, guys. Now, point 6. Make sure the wicks do not overlap the expansion candle. Step 7 is draw a box from wick to wick, full stop. That is your fair value gap. 8, look to buy when price retraces to a bullish fair value gap. 9, look to sell when price retraces to a bearish fair value gap. Okay? That is all I want you to focus on right now. A fair value gap is 3 candles, the first candle, the expansion candle, and the third candle. The direction of the first and third candle does not matter. All you need to focus on is the expansion candle. If the expansion candle is bullish, the fair value gap is bullish. If the expansion candle is bearish, the fair value gap is bearish. Make sure the wicks do not overlap the expansion candle. Then draw a box from wick to wick. That is your fair value gap. Look to buy when price retraces to a bullish fair value gap, and look to sell when price retraces to a bearish fair value gap. Okay, I'm going to give you just a couple seconds to make sure you get that down, and then we're going to move on to the next subject. Okay, guys. Okay, so that's what fair value gaps are. Okay, now that we've got that out the way, we can move on to the next subject. So, liquidity forms fair value gaps, and we want to look to trade them. We want to look to use fair value gaps to our advantage with liquidity. So we move on. What is that? ERL and IRL, okay? ERL and IRL, okay? Another subject to understand. I'm sure not as many of you who understand the fair value gaps will understand ERL and IRL. ERL and IRL, okay? Very, very quickly. It's very, very straightforward, this. I've shown you both of these things separately, and now all we're doing is combining them together, okay? So, ERL is highs and lows. So every single high, every single low is ERL. It stands for external range liquidity. So write this down. ERL equals external range liquidity. IRL equals internal range liquidity. Okay? External range liquidity, as I shown you at the beginning of this lecture, ERL is highs and lows. Okay? IRL is fair value gaps. So, write this down. ERL equals highs and lows. IRL equals fair value gaps. So you know how to look for liquidity, highs and lows. You know how to look for fair value gaps. Now we're combining those two things together. The name for that is ERL and IRL. External range liquidity, highs and lows, and internal range liquidity, inside the range, fair value gaps. Inside the range, fair value gaps. Okay? Exactly. As Abby has just said, internal range liquidity and external range liquidity. Write that down. Gonna give you a couple seconds to write that down. Okay? Okay, sorted. So, we know what ERL is, and we know what IRL is now. Let's look on the charts to see examples of it. So here is an example of ERL and IRL, okay? What I want to focus on is this move up right here. So, in this move up, we have lows like this right here. This right here. This right here. And that's it for now. We have lows and we have highs. So, ERL, IRL. ERL is highs and lows. Correct? IRL is fair value gaps. Okay? We know how to trade both of those things individually. Now we're combining both of those things, okay? So here, you can see all the ERL. I want you to focus on just this move up, this high here, and then this move up. Just focus on that, okay? You can see exactly how I've shown you. So we have highs and lows. We have ERL. We have highs and lows inside this move up. We have this high here, this low, and I've marked them all out for you. Every single liquidity zone is a high and a low. Low, low, low. All these highs here as well. It is literally as simple as that. So now we got that out the way. We need to look at the fair value gaps that are formed here, okay? So where are the fair value gaps? How do I identify a fair value gap? Well, what we look at is 3 candles. We focus on the middle one and look for that gap in between. Here you can see this is a fair value gap. Now, I'm going to ask you a question, guys, and I want you to reply yes or no in the chat, okay? Is this a valid fair value gap? Is this box right here a valid fair value gap? Let me know in the chat. Is this a valid fair value gap? Yes or no? Okay. Okay. Is that everyone? Okay. Couple people said no there. Couple people said no. Okay. Looks like that's everyone. A couple people said no. And I just want to talk about fair value gaps again. So, here we have 3 candles, okay? We have this bearish one right here, this bullish one right here, and this bullish one right here. That is our 3 candles, okay? Focus just on those 3 candles. So what is a fair value gap? We look at the expansion candle, and then we look to see if the wicks have overlapped. So we look at the first and the third candle and see if the wicks have overlapped. As you can see, the wicks have not overlapped. There is a gap in between those wicks. So we had the first candle, we then had the second candle, which is the expansion candle, then we had the third one. As you can see, there is a gap in between those wicks. That is the fair value gap. It is mitigated, that is correct. We're not focusing on that at the moment. It has been mitigated. Exactly. Gustavo has just said it there. Gustavo, you get extra points. You got that spot on, mate. The wicks do not overlap, which is what is needed to draw the box. That is a valid fair value gap. Okay. Now I'm going to draw out the rest of them for you, okay? You don't need to tell me if these are right or wrong. I'm going to draw them out for you, and I want you to focus on the actual move. Focus on the ERL and IRL of this move, okay? So, that's all the fair value gaps out the way. What we're going to do, very, very quickly, just before we continue, ERL is highs and lows. Yeah? ERL is highs and lows. IRL is fair value gaps. Okay? ERL is highs and lows, IRL is fair value gaps. Now if we look at this, you can see, remember to just focus on this bullish move, you can see highs and lows and fair value gaps. Now this is very messy because there's a lot of fair value gaps here, but this is ERL and IRL. This is how it works. What does the market do? Let's go back to that, guys. Remember the thing I told you at the very start of this lecture? What does price do? Seeks liquidity, offers fair value. Price seeks liquidity and seeks to offer fair value. Okay? So here, price has seeked liquidity by taking out these highs and left behind fair value gaps. Now let's start off with the first fair value gap we looked at and apply that concept. So price seeks liquidity and offers fair value. Here it came up, left behind a fair value gap. Just focus on this move up. It left behind a fair value gap, then came back into it to offer fair value, then moved to the upside, taking out this high. Then it came up again, took out this high. Okay, so it seeked liquidity, which was this high. It seeked this high. It took out this high, left behind a fair value gap after taking out the high, respects the fair value gap and continues up. It seeks liquidity and seeks to offer fair value. It seeks liquidity and seeks to offer fair value. It respects this fair value gap, this bullish fair value gap, which we look to take buys from. It respects this fair value gap, so we then continue up. We seek this high, continue up, leave behind two fair value gaps. Price comes in, respects both of these fair value gaps, this one here. Let's just go to this. And this one here. It seeks liquidity and then seeks to offer fair value. It seeks this liquidity, leaves behind a fair value gap, so it seeks liquidity, comes back to offer fair value, respects the fair value gap, continues up to take out liquidity. It seeks liquidity and then offers fair value, or tries to offer fair value. And this is where it goes a little bit different. So we seek liquidity and then form a fair value gap. Why do we do that? Because price seeks liquidity and seeks to offer fair value. I'm going to get someone to count how many times I've said this in this lecture. We seek liquidity and seek to offer fair value. Okay? Before we move on, I just want to focus on this move up. Okay, price seeks liquidity, leaves behind fair value gaps, comes and respects them, then continues up, takes out a high, respects a fair value gap, takes out a high, respects a fair value gap, and so on. That's what the move up is. Why does that happen? Because price only does two things. It seeks liquidity and seeks to offer fair value. Now, we know that ERL equals highs and lows. Okay? And IRL equals fair value gaps. Okay? As I've just shown you, price took out a high and then came to a fair value gap. So what we could say is that price goes from ERL to IRL. Okay? So price takes out the high, then comes to fair value gap. So it goes to the high, which is the ERL, and then goes to the fair value gap, which is IRL. So it goes to ERL and then to IRL. So price goes from ERL to IRL. It goes from the high because it seeks liquidity, then it goes to the fair value gap because it seeks to offer fair value. It goes from ERL to IRL. Write this down. Price goes from ERL to IRL. Okay? And then what does it do? It respects that fair value gap and continues the trend. As you can see, it respects the fair value gap, like this one right here. It respects the fair value gap. It offers fair value and then seeks liquidity. It takes liquidity, it takes ERL, comes to IRL, respects IRL, and goes to ERL. So you could say that price goes from ERL to IRL, goes from the high to the fair value gap, then it goes from IRL to ERL. So price goes from the high to the fair value gap, then price goes from the fair value gap to the high. Price goes from the high to the fair value gap, then it goes from the fair value gap to the high. It goes from ERL to IRL, and then IRL to ERL. So what you can do, I want you to write down price goes from ERL to IRL. Write that down. Price goes from ERL to IRL. Then price goes from IRL to ERL. Price goes from ERL to IRL. Then price goes from IRL to ERL. And what you can do is draw a little diagram. You can go E for ERL. A few of you would have seen this. You can draw E for ERL, then an arrow to I. Price goes from E to I. It goes from ERL to IRL. It goes from the high to the fair value gap. Then it goes from the fair value gap back to the high. It goes from the high to the fair value gap, respects the fair value gap, and then goes to the high. It goes from the high to the fair value gap, then from the fair value gap to the high. Okay? ERL is highs. ERL is highs and lows. IRL is fair value gaps. ERL stands for external range liquidity because it's outside of the range. IRL stands for internal range liquidity because it's inside the range. So external range liquidity ERL equals highs and lows. Okay? Internal range liquidity or IRL equals fair value gaps. So ERL is highs and lows, IRL is fair value gaps, price goes from ERL to IRL, then goes from IRL to ERL. Here's a nice little diagram. Price goes from E to I, then from I to E. Let's apply that to this drawing, or this chart. Price takes out the high. Price takes out the high, which is ERL, then comes to the fair value gap, which is IRL. Then from the fair value gap, it goes to ERL, which is this high over here. And that is what happens throughout this entire move up, okay? Now I want to move on to what happens here. So, price takes out this high. Okay, price takes out this high. Forms a fair value gap. So it takes ERL, forms IRL, then it comes back to ERL, looks like it's going to respect it, but then it closes outside of it and heads all the way down. What does that, what? I thought price was only supposed to respect the fair value gap and then go back up to ERL. I thought price was supposed to take out the high, respect the fair value gap, then take out the high again. What? What the flip? Okay. So, what's happened here? Price takes out the high, forms a fair value gap, then take out the high, then leaves behind the high, and you expect price to come and take out the high again. But it doesn't. It closes below it. What's that? That is called IFVG. IFVG. So we know that fair value gaps is FVGS. Fair value gap is FVG. Okay? Inverse fair value gaps is IFVG. IFVGS, inverse fair value gaps. Okay, so what's that? So we know what a fair value gap is, don't we? We know that. It's 3 candles. Doesn't matter about the direction of the first and the third. All that matters is the direction of the second. Okay? Here we have a clearly bullish fair value gap. Because why? Because the middle candle is bullish with the wicks here. Okay? So here we have a bullish fair value gap. What did I say before? I said that we would want to look for price to come back to a bullish fair value gap and then look to take buys off of it. Yeah, that's what I said before. But sometimes when we come back to the fair value gap, we will actually close behind it. So in a bullish example, a candle will close below the fair value gap. Yeah. And in a bearish example, price will close above the fair value gap. When this happens, this is called an IFVG. So we have inverse fair value gaps, or IFVGs. In a bullish example, it's when price closes below the fair value gap. And in a bearish example, it's when price closes above the fair value gap. So what I want you to do is write down, there's 2 types of IFVGs, there's bullish and bearish IFVGs, okay? What I want you to do is write this down. A bullish IFVG is when a bullish IFVG is when a candle closes above a bearish fair value gap. Write that down. A bullish IFVG is when a candle closes above a bearish fair value gap. A bearish IFVG is when candle closes below a bullish fair value gap. Okay? Now we know what they are. So when we close below a bullish fair value gap, we want to look to take sells. And when we close above a bearish fair value gap, we want to look to take buys. Okay? Okay. When we close above a bearish fair value gap, we want to take buys. When we close below a bearish when we close above a bearish fair value gap, we want to look to take buys. When we close above a bearish fair value gap, we want to take buys. When we close below a bullish fair value gap, we want to take sells. Okay. Now, how does ERL and IRL, where does that come from? How does ERL and IRL come into this equation? How does this work? Okay. Let's refer back to our first point of this episode, of this lecture. What does price do? It seeks liquidity and seeks to offer fair value. Okay. So, IFVGs are when a candle closes behind a fair value gap. How does that fit into ERL and IRL? Well, what's ERL? ERL is highs and lows. Okay. ERL is highs and lows. IRL is still fair value gaps. So ERL is highs and lows, IRL is fair value gaps. We've covered that already. IFVGs work the same way. Now let's go back to our little diagram we've drawn down here. So price goes from ERL to IRL. Price goes, in the example we looked at, price goes from the highs to the fair value gap. Then it respects the fair value gap and goes to the highs. But this rule is not a variable. This is fact. Price goes from ERL to IRL. In this example, it went from the high to the fair value gap. Then it respects the fair value gap and goes to the high. Price goes from ERL to IRL. Then price goes from IRL to ERL. You should have written this down already. You should know exactly what this means. Price goes from ERL to IRL, then price goes from IRL to ERL. This is a constant. This is always true. Okay? This is always true. But it does not necessarily always have to respect the fair value gap. So price will go from ERL, to I, which is IRL. Price will go from ERL to IRL, and then back to ERL. It will either respect the fair value gap and come and take the high, or it will disrespect it, which is an IFVG, and then it will travel to the other side of this ERL. So ERL is highs and lows, IRL is fair value gap. Price takes out a high, comes to a fair value gap, respects the fair value gap, then comes to take out the high again. Or price takes out the high, comes to the fair value gap, disrespects the fair value gap, and then goes to the low. A high and a low is ERL. Fair value gap is IRL. Price goes from a high to a fair value gap, then disrespects it and goes to the low. Or price goes from the high to the fair value gap, respects it and goes to the high. Let's take a moment to write this down, okay? Price will go from a high. Let's look at a bearish example, okay? Bearish ERL, IRL example, okay? Write this down exactly how I am. So title, bearish ERL / IRL example. Step 1, price takes a high. Step 2, on its way to take a high, it leaves behind a fair value gap. Step 3, after taking the high, in brackets, ERL, it comes down to IRL, to the fair value gap, in brackets, IRL. So right now you should have written down title, bearish ERL, IRL example. Step 1, price takes a high. Step 2, on its way to take a high, it leaves behind a fair value gap. Step 3, after taking the high, in brackets, ERL, it comes down to the fair value gap, in brackets, IRL. It disrespects it will either respect the fair value gap and continue up to ERL, or it will disrespect the fair value gap, in brackets form an IFVG, and continue to the low, in brackets ERL. Okay, so price takes a high. On its way to take the high, it leaves behind a fair value gap. After taking the high, it comes down to the fair value gap. It will either respect the fair value gap and continue up to the high again and make a new high, or it will disrespect the fair value gap, form an IFVG, and continue to the low, which is ERL. Okay? It is as simple as that. That's a bearish example. A bullish example, we're going to write this down too. I want you to copy this exactly how I have, guys. Bullish ERL, IRL example. Okay. Step 1. Price takes a low. Step 2. On its way to take a low, it leaves behind a fair value gap. Step 3. After taking the high, it comes down to the fair value gap. Sorry. After taking the low, it comes up to a bullish. It comes up to a fair value gap. My mistake there, guys. It comes up to the fair value gap. So, price takes a low. On its way to a low, it leaves behind a fair value gap. After taking the low, it comes up to the fair value gap. It will either respect the fair value gap and continue down, or it will disrespect the fair value gap, form an IFVG, and target the high. Okay? So, you should now have written down this. Price takes a high. On its way to take a high, it leaves behind a fair value gap. After taking the high, it comes down to the fair value gap. From there, it will either respect the fair value gap and continue up to the ERL, or it will disrespect the fair value gap and continue to the low. And you should have also written down, price takes a low. On its way to a low, it leaves behind a fair value gap. After taking the low, it comes up to the fair value gap. It will either respect the fair value gap and continue down, or it will disrespect the fair value gap and target the high. Okay? So, now that that's out of the way, all you need to do is draw this. Okay? Draw this diagram. E to I. It goes from ERL to IRL. From there, respects the fair value gap and targets ERL, or disrespects it. Okay, draw this out, and then at the top you want to put forms IFVG, and at the bottom you want to put respects FVG. So, price takes ERL, comes to IRL, respects the FVG and comes back to ERL, or disrespects the fair value gap, forms an IFVG, and then comes back to ERL anyway. In this case, high, think of it like this. It takes the high, comes to the fair value gap, disrespects the fair value gap, and comes to the low. Now let's go back to this chart, okay? So we looked at all this up here, yeah? We seen that price took highs, came back to fair value gaps, took a high, came to a fair value gap, and continued to take the high, formed a fair value gap, respected it, took out the high, formed a fair value gap, but then what did it do? It closed below it. Okay, going back to this example over here, When price closes below a fair value gap, what do? You look for sells. So price is closed below a bullish fair value gap here. So what do? You would look to take sells here with your stops just above here, which we'll get into in another lecture. And you can target this low, and even this low down here. For this example, we target this low, look to manage at this low. I'm going to show you exactly how to trade this soon. All you need to understand is the concept behind it. So price has came up in the uptrend. It has decided to form a fair value gap after taking the high, then respects the fair value gap, takes out the high again, which is ERL to IRL, then IRL to ERL. Here, it takes out the high, forms a fair value gap, disrespects the fair value gap, and then goes to ERL anyway. So it goes from ERL, which is the high, to IRL, which is the fair value gap, disrespects the fair value gap, and then comes to ERL anyway, which is the low. And you can see how this plays out. We just keep on going down. And as you can see, we take out the lows, we take out these lows, and what do we leave behind? We leave behind a fair value gap. You can see the same thing happens right here. We don't really come back to that one. We continue the trend down. But you see, we just do the same thing over and over again. We take out this low, come to a fair value gap, respect it, and just continue the trend. That's just how it works every single time. The better you get at identifying this, the easier it'll be to understand. But as you can see, the common thing here, the common theme is that price seeks liquidity and seeks to offer fair value. Okay? Okay. Now, let's have a game. Let's play a game. Okay? So, we'll answer all the questions at the end. Price takes out a low here, yeah? And leaves behind a fair value gap. Okay? So price takes out this low and leaves behind a fair value gap. It also leaves one behind here. So we've got two fair value gaps here, yeah? Oh, I ruined the game. Sorry, skip too far ahead. Let's see if we can. Okay. No cheating, guys, right? So, price just took out this low here and formed a fair value gap, okay? So we have liquidity here, don't we? We have liquidity right here. We took that out, left behind an imbalance. So we took ERL. Now what do? We go back to IRL, don't we? Okay. So we've come back to IRL. Okay. And we are respecting that fair value gap. We're respecting the fair value gap. So if we're respecting this fair value gap, what do we expect to do? Will price come up and take the high, or will price come down and take the low it's just formed? Answer that question, yes or no. Price has respected a bearish fair value gap. Will it take the low, or will it come up and take the high? High or low? Answer that in the chat, guys. High or low? Is it coming to take the high, or is it going to take the low? High or low? Nice, guys. Nice. Nice. Perfect. What I like to see. I think we're 5 for 5 now, I think, or 4 for 4. Exactly, guys. Everyone here. Emma, Alex, Big Deeds, Laura, Rodrigo, Scott, Lennon, Little Legs, Emma, As if. Wrong there. Rodrigo. Chetley. Justin. Exactly. And no Gustavo. Questions at the end, but Justin. Everyone. Perfect. 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 Apart from Asif. You got that wrong, mate. Let's see how this plays out. Okay. You were right, guys. We respected the fair value gap, so we came down and took the low. We went from ERL to IRL. Then we went from IRL to ERL. Perfect. So, how does this work with a break of structure and change of character? Okay. I assume most of you guys know what a change of character is and a break of structure. Break of structure is when we form a new low, so we broke the structure here. And a change of character is when we break structure twice. So that'll be a break of structure here. I'm not going to go too in-depth into that because that's not a concept that I want to focus on. You should already know what that is. If you don't, do not worry. But if you do, you're probably asking yourself, well, how do you tell the difference? What's the difference? Well, you should know, with a break of structure, you should know to wait for price to retrace first, yes? So here, price takes out the low, which is a break of structure, okay? So it takes out ERL, which is a break of structure, leaves behind a fair value gap, retraces into that fair value gap, and that's where you'd look to take your entry. Then we break structure again. Instead of just blindly taking a sell, you wait for price to come and retrace. Where do we retrace back into? The fair value gap. We respect it, so then you can take your entry looking to continue the trend. As I explained, price will take a high, come to an imbalance, and either respect it and continue to take out the high, or disrespect it and come out and take the low, okay? So price takes a high, then forms a fair value gap. From there, it will either respect it and continue the trend, or disrespect it and can come down and take out the other side of the low. This is a change of character right here, okay? That's a change of character. This is a break of structure. But this is a change of character. So what you want to do is wait for price to come back into the imbalance. And there's ways you can look for price to respect this, which we're going to talk about in the next lecture. But that is how a change of character and a break of structure works. We go from the high to the fair value gap and continue the trend, which would be the break of structure. Or we go from the high to the fair value gap, come down after disrespecting the fair value gap to take out the low, which would be a change of character. Okay, we're not going to go too much into that, but we're just going to focus, on like, what's the difference? That's the difference. They're kind of the same thing. You just want to wait for that retracement. So, liquidity and market structure. What you want to do is align liquidity sweeps with the daily session bias, which we're going to talk about tomorrow, and you want to avoid low liquidity setups. Now, we're coming towards the end of this lecture, guys, okay? So what we're going to do is we're going to answer some questions. I'm going to ask you guys some questions, and then we'll come back for the next lecture in a few days. But for now, I want you to stay here, and there's a little bit left to learn. So the actionable steps, what I want you to write down from this video, what I want you to be able to do is identify a liquidity zone, wait for a sweep, confirm it with the respect or disrespect of the fair value gap, align it with timing, and use tight stops near the liquidity zones, okay? Now, you might notice when you use the tight stops, you'll get stopped out. And that's what I want you to do. I want you to get stopped out, but I want you to be able to identify this, okay? I want you to be able to identify the liquidity zones, wait for a sweep, confirm your entry with a fair value gap, align it with the timing, which is like New York session or London session, and use tight stops near the liquidity zones. And what I want you to do, guys, to make sure that you understand this concept fully, join my Discord server after this lecture and send in your attempts at looking at these liquidity zones. So draw the liquidity zones, draw the sweeps, send in a picture of the charts to the Discord channel, and ask me, or ask the channel, whether or not this is valid. And I will get back to you, and other people too. Okay? So if everyone does that, and everyone helps each other, everyone here will fully understand what this is. Okay? That's the goal here. I want everyone to understand exactly what I've just shown them. So using your notes after this lecture, go and look on the chart AMD. We know what liquidity is now. We know what fair value gaps are. We know what IFVGs are. Let's understand AMD. AMD is the market's natural cycle. It is how it moves all the time. As I said, it's universal. So AMD on the daily translates to AMD on the 1 minute. There's so many different cycles going on at once. But what we want to be able to do is pick the right time frames, first of all, and we also want to be able to identify what AMD is. So let's begin. AMD, what is it? It stands for Accumulation, Manipulation, Distribution. I'm sure the majority of the people watching this know what that is. But as I said, as we did in the last lecture, we need to cover the basics first and build on that properly. And that is the only way you're going to learn anything properly. So, accumulation, where liquidity builds. Manipulation is where liquidity is swept. And distribution is where price moves directionally after sweeping liquidity. Okay, that's distribution is the real move in the markets. Let me see if I can draw on this. Is that a thing I can do? Let's see. Yes, so distribution is the real move in the markets, okay? That's what we want to be trying to trade. The whole idea of trading AMD is to trade distribution, okay? We identify the accumulation, we identify manipulation, and then we trade the distribution move, okay? That's the whole idea of it. And what I'm going to be doing today is teaching you how to trade that. But basically, the basics, there we go. What is AMD? Accumulation, manipulation, distribution. Price builds liquidity, sweeps liquidity, and then has a move. Let's have a look at that on the charts, okay? So, if you want to identify AMD and you don't know how to yet, there's one thing I need you to do, okay? We're going to just take a couple minutes just to basically get everyone on track with these tools. So, go to the left-hand side, the left-hand column, and you'll see multiple tools. I want you to hover over this square, okay? Geometric shapes it's called, and then basically click the arrow next to it. Then go down to rectangle, this here. Click the star next to it, and that will then add it to the widget that we've got from last lecture, okay? Click the rectangle and place it down, okay? Then go to settings. Sorry, I just locked it. Go to settings, okay? And just copy this. Get the background to orange with like 30% opacity, okay? Then go to templates, save as, and call that the accumulation. That's what it is, okay? Save it down. Then you've got an accumulation. Then change the color to green, save it down as manipulation, then do the same thing for blue, and call that distribution. They're the three colors we want to be looking at, okay? We got orange, green, and blue, accumulation, manipulation, and distribution, okay? Now that that's out of the way, we can actually look at what it is. So, what is accumulation? Accumulation is a consolidation where liquidity is built, where liquidity is generated. As you guys know from the previous lecture, liquidity is previous highs and highs and lows, okay? Liquidity is previous highs and lows. And accumulation is equal highs and equal lows, okay? Liquidity is previous highs and lows, and accumulation is equal highs and equal lows. So if accumulation is equal highs and equal lows, and liquidity is highs and lows, we can basically just go, accumulation is liquidity. Accumulation has liquidity on the top of it and the bottom of it, okay? And that's what this orange box is for. This orange box represents liquidity, represents the accumulation as well. We have a clear accumulation right here, don't we? Because price is going sideways. It's a tight range where price is building liquidity. That's all it is. It's a consolidation, okay? That's what you need to understand. An accumulation is a consolidation. But this is what the three phases look like. So first we will consolidate, then we will break out of that range very, very quickly, usually, like this, a swift upwards move. We label that manipulation. Price has been manipulated to take out all these highs here. So there's highs here, you know, there's a high right here as well. Like every black line represents liquidity. You know, all these highs on the top side of the accumulation range has been swept by this one candle right here. And that is the manipulation. And then straight after we swept all of that, what happened? We had a massive move to the downside. Now, not always it will look like this. It will never ever just be like 20 bearish candles in a row. But that's exactly what AMD looks like. It's an accumulation where price goes sideways, then breaks out of that range, which is called a fake out, where it basically hits people's stop losses, as you know, because you know what liquidity is. We target people's stop losses, get people into trades in the wrong direction. So inside this circle, people will have their stop losses, and people will also be looking to take buy positions from that area. They'll go, we've got a breakout right here, and you'll probably see those breakout traders on TikTok, on Instagram. People will have breakout trades, and they'll try and trade breakouts only to lose because price just does this in the end anyway. And the reason it loses is because they're trading the manipulation phase. They're trading the fake out. That's what this is. It's an accumulation. Then we come to the upside, take out people's stop losses, and then also get people into trades. People will take buy position. They'll go, we've got a break of structure right here. You guys know exactly what I'm talking about. We have breakout structure. We have a break of structure all over here. People go, price is now bullish after sweeping these lows. Then price just reverses. Okay. Do you see that? Now, I'm not going to explain this as much as I just did. We just take out a low. Okay. We accumulate, reverse, which is the manipulation. Then we reverse again and have the actual move. So this is a clear example on the charts of accumulation, which is the sideways price movement, the manipulation, where we come to the upside, and then the distribution to the downside, okay? This is what it looks like. This massive move to the downside is what you're going to be looking to trade and what you're going to be able to trade once you understand how AMD works, okay? Now, what I also want you to focus on is the price. The time of price movements. So look at the time that this was going on. Look at the bottom of my chart. I don't know if you can see this clearly, but if you look at the bottom of my cursor, you can see that this was around about 11 o'clock. Okay. Then we manipulated just before 12 o'clock. And then 12 o'clock comes, we're leading into the New York session, and we start having this massive distribution move down. Okay. Keep that, note that down, whatever you need to do. But that's what AMD looks like. We have an accumulation, we have a manipulation, and then we have a distribution. That is what AMD is. But now, we need to dive deeper into each of these phases. Now you know what AMD stands for, and now you know what it looks like. We need to actually dive deeper into each individual stage. We need to look in depth at an accumulation, in depth at a manipulation, and in depth at a distribution, okay? So, now we can move on to the second example. And this is the characteristics of all the different phases, the characteristics of accumulation, the characteristics of manipulation, and the characteristics of distribution, okay? I'm going to read through these PowerPoints very quickly, then we're going to go onto the chart, and I'm going to show you exactly how you could have traded this price action right here. So, an accumulation, what is the characteristics of it? As I just said, it's a consolidation zone with tight price ranges, low volume, minimal volatility, and liquidity builds on both sides of the range. What's a manipulation? Sweeps above accumulation, it can go either side, and then it triggers stop losses and entices retail traders into trades. As I said, you'll have those breakout traders who look to trade the breakout of the consolidation. They lose, and that's why, because it's actually just a manipulation to sweep liquidity and entice them into that trade. And then the manipulation phase will often create a fair value gap as well. Now, you know how to trade IFEGs, you know it, you know fair value gaps. So as I go through AMD, it should start to come together a little bit better. But basically, manipulation creates fair value gaps. Now, distribution is where price breaks out with momentum and follows the institutional daily or session bias. So, you know IFEGs, ERL, all that stuff. Distribution aligns with the bias. So this is what I'm going to, in the next lecture, I'm going to be teaching you how to find a bias. But for now, we need to focus on AMD. So we've got the accumulation, manipulation, and distribution. Let's look at Bitcoin, okay? So a few people will see this and be really confused, and it's just very messy price action to them. But to us, it's very clean price action. It's very nice price action. And we could have traded all of this, okay? What we're going to do is we're going to start off over here. So an accumulation, as I said, is a tight range typically. It's where price goes sideways, okay? Now, that's not always the case. Not always the case. Sometimes we will have this type of move where it's very small candles, very tight range. As you can see, if we just measure the pip distance on this, I don't know if it's a little bit different, yeah, because we're on Bitcoin. But you can see it's a very small move. Now, if we look at the second accumulation, which is right here, it's a lot wider. Like if we just take this accumulation and put it on here, you can see that it's near enough like double the size, okay? They're both accumulations, but one's bigger than the other. Okay, so the characteristic, or what I want you to take away from that, is basically the accumulation phase doesn't necessarily need to be a very small range. It's a tight range. So it doesn't have to be like this. It can sometimes just be like this, exactly how I've drawn it here in front of you. Okay, now that I've drawn these two accumulations out, it should kind of make sense how price has been moving. But let's just draw it out. So we have the accumulation. It can be a tight range. It can be a very wide range. It can happen through Asian session, as you can see here, and it can happen through after New York session. So if you just look at the time again at the bottom of my chart, you can see at 2:45, which is like just after the New York Open, we started consolidating. Yeah. Then we had a manipulation and a distribution. Then at 8 o'clock, we started consolidating again, leading into the Asian session. Then we manipulated down, and then we distributed up. And this happened through the end of New York to the start of London. Excuse me. Sorry. So you can see that it's not necessarily bound to a session time, but I'm going to show you how to read the manipulation and the accumulation and distribution depending on what time it actually takes place. And we're going to be looking at the variance of AMD, but for now I want you to focus on the characteristics of AMD. You know what AMD looks like. This is the characteristics of it. Sometimes we can have a very tight range, sometimes we can have a very wide range, but what I want you to focus on is it's a consolidation. Okay? Let me just, what's going on here? Keeps messing up. Let me just refresh this. So, Josh, I usually mark PDH and PDL as my market structure shifts. You don't really need to look at market structure shifts. Bilk, and if manipulation does offer fair value gap, what to do. I'm going to show you exactly how to trade all of that. Let's go back to Bitcoin. Where were we looking? That's annoying. This website keeps bugging up. Where were we? We can see the AMD playing out here. I've lost where we were on Bitcoin. This is annoying. I think it was the 22nd, wasn't it? Ah, here we go. Right, so we're back. Sorry about that. But you can see, basically, the different types of the accumulation. We have a very small range and a very wide range, okay? Now, the manipulation. Manipulation here is to the upside, okay? Yeah? Coming into a fair value gap. Yeah? You see that, guys? The manipulation here comes into a bearish fair value gap formed and then heads down. Then we have the distribution. Okay? And then right after distribution, we have another manipulation. Okay? Then we have a distribution, but this time the distribution goes down, but that's not what I'm focusing on here. What I'm focusing on is that manipulation didn't go into a fair value gap. It created one. It did also create one here, but it came into this one. It didn't come into one over here. It actually just swept liquidity. As you can see, it took out the lows. So we come down, take out the lows, leave behind a bearish fair value gap right here. And then we inverse that. So this should start to come together now. You should kind of start clicking together. So you know how to trade IFVGs, okay? You know how to trade, let me write that down. How to trade IFVGs. We sweep liquidity, ERL, IRL, all that stuff. And that's exactly what's happened here, okay? We take out these lows. Then we have a stop hunt. We have a stop hunt right here, creating a bearish fair value gap, which we inverse very, very quickly. So you would take your entry right here with your stops a little bit just below here, and your take profit goes at a previous high over here, like this one right over here. So once you've learned to trade this at the end of this lecture, you're going to be able to take trades exactly like this. We would have even took a trade here as well. We would have took a trade right here. but more than likely we were probably targeting this area. And this trade as well, this is a perfect setup. Hey Rodrigo, how's it going? So, you know how to trade IFVGs, you know ERL and IRL, okay? I'm showing you it applied to AMD and how AMD and IFVGs tie in together. The best IFVG setups come alongside AMD and vice versa. Okay, what I'm going to do now is I'm going to get rid of these drawings and I'm going to just walk through it in terms of ERL and IRL, okay? So, let's start over here. We take out this low. Actually, tell you what, let's start over here, okay? We take out this low, left-hand side, create a bearish fair value gap, come back into that. So we take out ERL, then come back to IRL, yeah? Then come all the way down again after respecting IRL. Take out the ERL again. This should all make sense. You should not be confused at all right now if you see in the first lecture. We take E, come back to I, respect it, come all the way down, create multiple fair value gaps, and as I've shown you, when you do that, you just go up a time frame, which means there's probably going to be one there. If we just look at the times, there is. We come back into this fair value gap over here after taking out the low, respect it, come back down, take out the low again, come back up, coming to retrace back to this fair value gap, disrespect it, so we take out the high, okay? But we didn't leave an imbalance here, so we would not look to trade this 3 candle move, okay? We then come down, take out the lows, leave behind a fair value gap, and this is a little bit volatile because we kind of close outside the range, but then we just reverse straight away anyway. There is also a fair value gap right here. Then we come down, take out the lows, leave behind a fair value gap, then inverse it very quickly. So you take your entry here and you would target the high. You would go and target this high all the way up here. That would be your full TP. Then you would look to manage at this high over here and this high over here as well. So once this high gets took out, you then move to break even. That's how it works. Or you can take partials and move to break even. I typically just move to break even. Then around about here, I would look to take partials, and then we hit a full TP taking out this high, okay? It's literally as simple as that. So you know how to trade IFVGs. You know what AMD looks like. I've just shown you how those two things combine together. The characteristics of them. What I want you to write down from this, the characteristics of each is accumulation, okay? Can be a small or large consolidation. Okay, write that down. Accumulation can be a small or large consolidation. Okay. Manipulation. As you should already know, manipulation can take ERL or come to IRL. So you can have a manipulation into IRL or into ERL. Okay. Distribution is either a move to IRL or to ERL. Okay, write that down. I'm going to just draw this out in front of you. So accumulation can be a small or large consolidation, as I literally shown you over here. Manipulation can either take ERL, like how it took out this low over here, or it can come back to IRL, exactly how it comes back to this fair value gap over here, which is IRL. Then distribution is either a move towards IRL or towards ERL. As you can see, this distribution right here was a move towards ERL. It was a move down after respecting IRL. So we take the low, which is it. We take ERL, come back to IRL, then go back to ERL. The going back to ERL occurred through the distribution phase. Then we consolidate, then we manipulate down, taking ERL, then we move towards IRL again. But this will be a higher time frame one, as you're going to understand. Okay, so write that down. Accumulation can be a small or large consolidation. Manipulation can take ERL or come to IRL. And distribution is either a move to IRL or to ERL. I'm going to give you guys just 1 sec to write that down. You don't need to understand timeframes at the moment, guys. I know you want to understand timeframes, but I'm going to show you timeframes later on in the lecture. For now, all you need to understand is the concept, okay? All you need to understand is the concept. Once you've learned the concept, I'll show you exactly how to apply it on the charts, which will happen in this lecture, okay? So write this down. Make sure you know that. That's the characteristics of AMD. It's not just a clean, simple one size fits all rule. Sometimes we can manipulate into a fair value gap. Sometimes we can manipulate to take a low, and vice versa. So that's the characteristics of all those things. Now we're moving on to something called AMDX, okay? You might have seen this written down somewhere. You might have seen it in my videos. You might have seen it in other people's videos. But what this means, or what this stands for, is accumulation, manipulation, distribution, and expansion, okay? I'm going to give you guys a sec just to wrap your head around AMD first before we dive straight into this. So just make sure you get that written down and stuff like that, okay? Let's see if you've got any questions. By the way, guys, sorry, excuse me. It's probably this monster, but by the way, guys, if you've got any questions, try and save them towards the end of the lecture, because what you'll find is they will probably be answered. And we're also going to be doing like a Q&A section at the end of the lecture. So save your questions till the end. Ghost, if you want to understand IRL, that is literally fair value gaps. And if you want to understand that on a deeper level, you need to watch the first lecture. As I said, lecture 2 is building on lecture 1, so it's very important you've watched the first one before you try and understand this one. I cannot unsee it on our lecture 1. Game changer. Nice to hear. Time for TF is time frame. Yep. I can be profitable. Waiting for this. Yeah, so that's what AMD is. Okay, they're the characteristics of it. How do you identify your daily bias? As I said, guys, ask the questions at the end of the lecture. Okay. No worries, Ghost. Nice to hear. But AMDX now, you should understand what AMD is. I've given you a few seconds just to understand it and write it down. Okay, AMDX is what we're looking at next. So, the timings of AMD affects how the cycle will play out, okay? So, AMD, depending on the time frame, will play out differently. Well, not the time frame, but the time that it's playing out. So, if AMD is playing out, like, let's say we've got a London accumulation, it might play out differently than we would if we had an Asian accumulation, okay? Sometimes we can have a complete reversal after distributing, and that is the X phase, okay? The X phase, or the expansion phase, is either the continuation of distribution or a complete reversal after the distribution. And this is what it would look like very, very quickly drawn. So, we have our nice accumulation, then we manipulate up, distribute down, and then we have the X phase, which is something along these lines, okay? We'll have the distribution, and then we might have the X phase, which is this. So, accumulation, you know what that is, AMD, all that stuff, you know exactly what this is. Right now, we're going to be focusing on the X phase, okay? So, if you're making notes, great. If you're not, start. New heading, AMDX, okay? That's what I want you to write down. So, AMDX, what is it? We can get rid of this now. We don't necessarily need it. What we're focusing on here is AMDX, okay? So, first we need to just very quickly cover the sessions. So the Asian session, you already know this, guys. Asian session, low volume. London session, or London and New York session, high volume. Okay, simple stuff there. Asian session is low volume. London and New York is high volume. Very, very, very straightforward. Okay, so let's say, hypothetically, we have a distribution move. We have a distribution move through Asian session, okay? Because London and New York has such high volume, do you think we're just going to accumulate for the rest of the day and then manipulate and distribute again in Asian session? If we distribute through Asian session, what do you think is going to happen through London session? Will we just go sideways, or will we go up, or will we go down? That's not a question. You don't have to answer that, but it's like a rhetorical one. The answer is we will just basically have an X phase, which is the expansion phase. As I said, the timings of AMD can change slightly how each cycle plays out, okay? So here you can see we have a very clear accumulation. Look at the times, okay? You need to look at the times. That's probably the most important part of this lecture. Look at the times. So we start a consolidation at 3:30, finish it at 12, then manipulate down till like 2 o'clock. Then after manipulating, we completely reverse. And by 6 o'clock in the morning, which is when, we'll be waking up, we've already had the distribution. Okay? See how it's targeted ERL here, by the way? But you see this. So this entire cycle of AMD played out through Asian session. This entire cycle played out through Asian session, okay? So through Asian session, we have basically distributed. But as you guys know, Asian session typically has low volume and London and New York has high volume. So because London and New York have such high volume, do you really think we're going to just start consolidating through London session? No, of course we're not. We're going to have a move. Okay? And as you can see, we do. Focus on the times here, guys, okay? So we start a consolidation at 3:30, which is coming towards the end of the kill zone, or the AM kill zone for New York. We finish it at 12. Then we have a manipulation move at midnight till 2 o'clock. And then we distribute through Asian session coming into the London session. So we're coming into London session with a distribution. So we've literally distributed into London session. Okay. If we've distributed into London session, are we going to consolidate? Answer that question in the chat. If we've distributed into London session, are we going to consolidate through London and New York? Answer that question. Yes or no in the chat. If we've distributed into London session, what are we going to do? Are we going to consolidate? If we've distributed into London session, are we going to consolidate? Yes or no? Write that in the chat, guys. Exactly. Everyone's got... Abby, you got that wrong there. Exactly. Everyone else has got that perfect. Dan, Emma, Ghost, John, Azif, Philip, Adele, George, Scott, Chris, Angie, Alex, Clutch, Slay Fox, Habib, Jay, Joe, Emma. Joe, don't know why you said yes. And you, Jay, don't know why you said yes. There are too much volume to consolidate. Exactly. Everyone, near enough everyone there got that right. If you said yes, I'm not too sure if you were just listening, because I did say, I've already given you the answer, but yes, everyone who's answered there and said no, that is perfect, spot on. That is the correct answer. We will never really ever consolidate in the London and New York session unless there's no red folder news, okay, which we're going to be looking at soon. But typically, we will always just continue the cycle. So, now that that's out of the way, now that I know you understand that, that's what AMDX is. AMDX equals accumulation. So write this down, guys. AMDX equals accumulation, manipulation, distribution, and expansion, okay? Now, let's just focus on the expansion. We've got that out the way with the timings. We've discussed that. We've got that out the way. Now let's focus on the expansion, okay? Let's just scribble over all this. We don't need to look at any of this. All we need to focus on is the expansion phase, okay? That's all we need to focus on, the expansion. What can that be? The expansion doesn't necessarily need to be a continuation of distribution. It can also be a reversal and vice versa. So, write this down. Expansion. Or let's write this down, okay, guys? The expansion phase of AMDX doesn't have to be a continuation. Then another note, the expansion phase of AMDX will either be a continuation of distribution or a complete reversal. Okay, write that down. The expansion phase of AMDX doesn't have to be a continuation. The expansion phase of AMDX will either be a continuation of distribution or a complete reversal. Okay, as you can see right here, it was a complete reversal, and it all depends on the timings. As you trade, as you practice this, you will pick this up. I can give you the answers, but as I said, you need to do that. You need to build the intuition. There's explicit and implicit learning. What you're doing now is explicitly learning something because I'm giving you the answer, basically. You need to implicitly learn this, okay? And implicitly learning is basically building intuition. So the more you practice this, the more you will pick up on this. When you wake up, let's say on Monday, when you've spent the weekend practicing this, on Monday you go and apply it, you'll wake up, you'll see that, oh, we've just distributed through Asian session, so I can probably take a trade through London session because of the volume. And then we literally get a perfect IFVG setup right here. Take out the high, inverse this, so you can target the low over here or this low over here, and you can take a trade. Granted, you're not trading the distribution phase, you're trading the expansion phase, but it all depends on the timing. If you're trading the expansion phase, trying to catch it, like if we've right, let's just say an example. A bad example would be if we've distributed through New York session, will we consolidate? Trying to find a way to ask this question for you guys. If we've distributed through New York session, okay, what are we more likely to do? Accumulate or expand? Answer this in the chat, guys. If we've distributed throughout the New York session, what are we more likely to do? Are we more likely to accumulate or expand? What are we more likely to do? If we've distributed through New York session, we've distributed through New York, answer this in the chat. What are we more likely to do? Accumulate or expand? Exactly, yes. Accumulate, exactly. Accumulate. Everyone, Dan, Autumn, Abby, Little Legs, Chris, Dexter, Clutch, Lennon, John, Slay Fox, Jay, everyone, accumulate. The accumulation, yes, exactly. Exactly as Emma's just said there, guys. Low volume, therefore accumulation. That is exactly true. Perfect, spot on. Harry, Chris, Hezbollah, perfect, guys. That's exactly right. Perfect. I'm so happy we got all that right. There were a couple people who said expansion, so I just want to re-emphasize this. Okay. It all depends on the timings, okay? It all depends on the timings. If we've distributed through Asian session, you can expect an expansion. If we've distributed through New York session, you can expect a accumulation because there is low volume. Where is it? I've lost it. But because there's low volume throughout the Asian and New York session, the answer is accumulation. Accumulation, guys. Perfect. You all got that right, near enough. The answer is accumulation because there's lower volume in the Asian session, okay? I'm happy with the progress we're making at the moment, guys. Let's just do a very quick recap here. So everyone knows this now. We know what AMD is. We know what each phase of AMD looks like, okay? We know the characteristics of each phase of AMD AMDX, okay? We know what AMD is. We know what each phase of AMD looks like. We know the characteristics of each AMD, of each phase of AMD or AMDX. Perfect. Now let's move on. So not only is there AMD and AMDX, but there is also something called AD. This is AD cycles, okay? AD cycles. Okay? So we have AMD, we have AMDX, but sometimes we can have A and D. So sometimes we may not need to generate any liquidity, or there will be a stronger liquidity pool somewhere else. So sometimes we don't need to generate any liquidity. What's the whole idea of manipulation? To generate liquidity. Okay, that's the whole idea of manipulation, is to generate liquidity. Sometimes we don't need to generate liquidity, okay? And you will see this happen a lot as well, where we have this type of move and we just move down, 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 and just continue all the way down. That is AD, okay? As Bill asked, if distribution is in New York session, Asian session will typically accumulate. You will know the direction of distribution once I've shown you the phases, okay? So, we have AMD, we have AMDX, and we have AD. AD is when we do not need to generate any liquidity. We will just have a big move, okay? So let's look on the charts and look at some examples of that now. So, here you can see a clear consolidation, yeah? We can all agree that's a consolidation right there. I just want to put a point on. Straight after a distribution, by the way, we have an accumulation, manipulation, and distribution. Then we have an accumulation. But you can see we have a massive move to the upside, which looks like a distribution. But there's no move to the downside first. We don't move down and then move up. We literally just go straight up, don't we? Can you see that? We literally just go straight up. Okay? This is a perfect example. This right here is a perfect example of A and D. Okay? Now, note making time. AD, okay? New heading, new subheading, whatever. AD is short for accumulation distribution. Okay? It is an AMD cycle without the manipulation. Okay? AD is short for accumulation distribution. It is an AMD cycle without the manipulation. This right here. And the way I'm going to get you to understand this is simply just by asking you the question, what's the idea of manipulation? Why do we manipulate? We manipulate to generate liquidity. Okay? So what is an AMD? What is an AD cycle? It is a move where we didn't have to generate liquidity. Okay? So, exactly, guys. I can see a few people answering that. We manipulate to generate liquidity and to take liquidity. Exactly. Why do we manipulate? We manipulate to generate liquidity. So what is an AD cycle? It is a move where we didn't have to generate liquidity. Okay? So make sure you write this down. This is probably the most important point about AD. It is a move where we didn't have to generate any liquidity. Okay? Very straightforward there. Now let's go back to the charts. You know that this is now an accumulation distribution cycle. Okay? How do you trade this? How does it work? So many questions. Okay? So, first things first, you don't need to trade AD. Okay? You don't need to. But if you want to, you have to add context. It all depends on the context here, okay? Like if we go to the 2 hour time frame here on gold and look at that accumulation, you can see it's right near a high. So you wouldn't have looked to trade this one because we just took out a high over here. You wouldn't expect this to play out how it did. Okay? That's rule number one, really. You have to look at the context. But if, let's say, for example, right, let's just say that there was liquidity all the way up here. And let's say that's where there was a high. You could expect price to continue up. But how do you trade this? Like, how do you trade AD? Well, first of all, you can see a clear cycle of IFVGs, ERL, IRL, all that stuff right here above the accumulation. Right here. Okay? So, if you were to trade this, which you shouldn't because we just took out a high, but in other context, what you have to do in general to trade AD, you just wait for an IFVG to form. Just like this one right here, okay? But it all depends on the price action. And this leads me on perfectly to the next subject, but I want you to understand that AD is simply just an accumulation and distribution where we didn't have to generate liquidity. But I'm sure you want to know, how do we trade all of these things? You know what AMD is, you know what AMDX is, you know what AD is, you know all the cycles, you know all the phases. How do you actually place a trade and make money from this? Well, that's very, very simple. Let's move on to the next subject. So, you need to look at good and bad price action, okay? Good and bad price action. It's not necessarily just about catching the end of the manipulation move like this and getting in here and taking profits down here. It's simply just looking at the price action, okay? Just look at the price action. There's a thing as good price action and there is also bad price action, okay? I'm going to show you exactly what that is and what it looks like using AMD. Now you understand what AMD is, you can identify whether or not we have good and bad price action. All these questions, guys, ask at the end of the course or the end of the lecture. I'm sure your question will be answered by then, but we are doing a Q&A at the end of the lecture for any questions that you guys have. But yeah, good and bad price action. What is it? What does it look like? Let me show you. Now you know what AMD is. We can use that to identify good and bad price action, okay? So let's go over a few examples. We can literally just use this chart, okay? And I'm going to show you some examples here. So very, very quickly, we've just had, get ready to answer these questions, guys, because you're going to be answering this for me, but we've just had a strong push up, okay? So use AMD to work this out. We've just had a very strong push up, which looks like it's probably distribution, as you can see. So would we look to trade here? Do we want to trade this? Yes or no? Answer in the chat. Do we want to trade after a massive push up? Yes or no? Abby, you're correct. We're going to be moving on to that very shortly, but do we want to trade this? Yes or no? Exactly. Everyone here, no. No one has said, oh, one person said yeah. Everyone has near enough said no. Exactly, guys. Exactly. Spot on. We do not want to trade right after a push up. Okay? Let's use AMD to understand why. Perfect. Everyone is saying no. Perfect. That is the correct answer. We do not want to trade after a massive move in either direction. We don't want to trade it. And that's because of AMD. Okay? So let's see what happens after this. Some of you guys may have already seen this, but let's see what happens, okay? Okay. Exactly. we don't want to trade straight after a distribution move because we're more likely to consolidate than anything else. Okay. So what we just seen was this move right here. We just seen the distribution move, and I asked you guys, should we trade it? You guys said no, and that's correct, because what happens after D more than likely is an accumulation. Now, as you guys know, we do have phases like AMDX and AD, but it all depends on the context, okay? Now, how does it depend on the context? What does that mean? You guys said no. You guys said we shouldn't trade, which is perfect. But I'm sure a lot of you didn't understand why. It's actually, if you look at the bottom, you can see the time frame, okay? Look at the time at the bottom. You can see 4 p.m., 1600. For me, that is the end of the kill zone for New York session, for the AM. So we're heading into the Asian session now. All of this is heading into Asian session. Okay, Asian session starts around about here for me, but all of this is heading into Asian session. We've had the New York volume, we've had the London volume. We don't necessarily need to get another move. Why does that make sense? Or why do we do that? Because, as I said, in the last piece that I just shown you, when we distribute through New York, we expect Asian session to accumulate. Exactly how someone's just said, low volume, exactly low volume. Asian session has low volume. We've just distributed through New York, which means we're due an accumulation, but also we're heading into Asian session, which has historically low volume. So there's them two reasons as to why we would not trade it. Not only would we not trade it because we've just had a distribution move, but we would also not trade it because we're heading into Asian session. If we had this distribution move coming into London session, we might look at trading it because then we can expect price to expand. But as we're heading into Asian session, we would look to actually just start accumulating. Therefore, we would not look to trade after this move up, okay? That is bad price action. Technically, it's good price action because we've had a nice move up, but it's a bad time to trade. It's bad structure because we've had just a very quick push up, okay? That's exactly how it works. Now let's look at another example. Okay, right. What about this? Would we look to trade this? We've just had an accumulation. But would we look to trade this? Before you answer this question, look at the time. Would we look to trade this? Would we trade this? We've just accumulated. Would we look to trade it? Exactly. Big Deeds, Abby, Asif, Habib, Suresh, Emma, Dexter, Little Legs, Chris, Emma, also a Friday, Habib, Scott, Suresh. Exactly. No, you do not want to trade this at all. You don't want to trade this. Perfect. Okay? Perfect. Now, we do technically have a move up after it, which is the distribution. But you would not trade this because we're heading into Asian session, okay? There is a manipulation, Artem. There is a manipulation. But with the manipulation as well. So you guys said no, which was correct, okay? Let me just write this down. We accumulated, which would be good price action. But we accumulated leading into Asian session. Okay? Plus, as Emma said, it was also a Friday, but I want to focus specifically on this. We accumulated, which would be good price action typically, but we accumulated leading into Asian session. Based on AMD alone, we would not trade this. Not even AMD, based on price and time. Just based on price and time, we would not trade this. We've gotten a consolidation, which is great, but we're consolidating leading into Asian session. As Big D had said, low probability trade. There's more than just one reason for this though, and this is how I'm gonna teach you to trade this, okay? So, write this down. We accumulated, which would be good price action, but we accumulated leading into Asian session. Based on price and time alone, we would not trade this at all, okay? Now, second point, okay? Good price action is when we go into London or New York with a consolidation. E.g., we accumulate through Asian or London. Okay? That's good price action. So, make sure you got all this written down. We accumulated, which would be, or if we accumulate heading into Asian session, do not trade it. That's bad price action. Good price action is when we go into London or New York session with a consolidation. E.g., we accumulate through Asian or London. That's what good and bad price action is, okay? It's a mix of scalping and day trading. I trade on the 5-minute time frame. But anyway, guys, that's what good price action is. You want to see a consolidation if you're going to trade the IFVG setup. You want to see slow, choppy, speed bump price action like this or like this if you're going to trade an IFVG setup, okay? You want to see this, and that's because of AMD. You want to see that accumulation, then we manipulate, creating that fair value gap. We then inverse it and trade the distribution, okay? That should be the trade you're looking to take. So good price action is when we go into London or New York session with a consolidation. Let's write that down even more. Let's refine it even more. You only want to trade IFVGs when we have accumulated before the IFVG was created. And you will see this as you trade. If you go down and backtest every single IFVG setup, you will see most of the losing trades have two things in common. They're against the draw on liquidity and they're after a very quick move, okay? Literally as simple as that. So make sure you've got all this written down, guys. We accumulated, which would be good price action, but we accumulated into Asian session. Good price action is when we go into London or New York session with a consolidation. You only want to trade, this is the key point here, guys, you only want to trade IFVGs when we have accumulated before the IFVG was created, okay? Write that down. Make sure you've got that. That's the key point of trading all of this. This is the whole idea of why I'm teaching you AMD. Okay, so make sure you got that down. Okay? That's what good price action is. Going into London session, going into New York session with an accumulation. Okay? Like here. Now, you may have already seen the answer here, but based on what I've told you here, okay? Let's see, let's take this with us, okay? We're going to take this up here with us. Now I need you to answer the question again for me, guys, okay? So, if you only want to trade IFVGs when we have accumulated before the IFVG was created, here we've got an IFVG form right here, okay? Would this be a good time to trade? Answer in the chat. Would this be a good trade? Yes or no? Yes or no? We've just accumulated, manipulated up. We've got that nice speed bump, slow price action. Then we create the IFVG. Would this be a good time to trade? Yes or no? Exactly. Everyone has said yes. Not one person has got this wrong, which is perfect. Big Deeds, Laura, Asif, Little Legs, Habib, Jovan, Chris, Emma, Maidens, Universe, Abby, Vitali, Rodrigo, Scott, Suresh, Artem, John, Wayne. Exactly. Perfect. Exactly. You would look to take a sell here for multiple reasons. Now, you may already be in this AMD trade over here. You may already be in this one from this fair value gap created over here. But if you wanted to take a re-entry and you're looking at this cycle, this is where you would look to trade again. It's just simple stuff. I'm going to walk through this all together, but this is a perfect trade. Multiple reasons, okay? Multiple reasons. This is a great trade. You are correct if you said yes. This is a great trade. Why is it a great trade? One, we've had an accumulation throughout the London session, inside London session, which means we've still got volume. We're going to get more volume as we head into New York session. So we can look at trading this, okay? That is reason number one. Second reason is if we look at ERL and IRL, okay? Let's just look at ERL and IRL. Completely remove the idea of AMD for a second. There's this low over here. There's this low over here. Okay? And there's obviously this low right here and this one up here. But focus on these two. So we take E, we go from ERL, we take ERL, yeah? Then we come back to IRL, which is this fair value gap right here, and respect it, and then head down. So you would look to trade this. This would be a perfect trade, okay? Perfect trade. Now, let's look at the move before this. Okay? There's like all AMD. This is all just one accumulation here. Okay? This is all one accumulation. This is all through our Asian session right here. Okay? Then we come up over here in the manipulation, form a fair value gap, coming into London session. Then we inverse that fair value gap here, and that's where you look to trade. You'd put your stop loss just above this high, and your take profit would go all the way down here. So you would take one trade here, take profits. After distributing, we then accumulate again, manipulate, and then you get in for trade number 2, okay? So on Friday, the 27th of December, by like 12 o'clock, you already took 2 trades. Exactly, yeah. Using AMD on the 4-hour works well. Should we wait for it to reverse to IFVG? You can look for it to inverse the IFVG. You wouldn't wait for it to reverse to it at all. How you want to trade IFVGs, how I explained in the last lecture, when you do this, you don't wait for it to come back and do that. You just wait for it to close below here. Simple as that. So you don't have to wait for it to come back at all. But this is a perfect setup. 2 trades, perfect setup because of the time and the structure behind it, okay? Now, let's actually move on to the next subject, okay? So now you know, let's just do a quick recap. You know what AMD is, you know what accumulation looks like, you know what manipulation looks like, you know what distribution looks like, you know what AMDX is, you know what the AD cycles are, you know what good and bad price action looks like, and now you can look at trading it using AMD fair value gaps and liquidity to spot high probability setups. Okay, so this is where you're going to be learning to actually take your entries. Okay, this is where you're going to be learning to actually take these trades. Okay, so here is another example of a trade that you would look to take. Okay, but you wouldn't trade this because we're in Asian session. Now, I just want to show you how it works though, okay? So, when you're taking your entry, the way you would want to enter, very, very simple. Let me write it down first. So, this is going to be like the steps for it. So, on the daily, you find your bias. You found your bias on the daily and the 4 hour. I've given you the bias. Okay, the daily and the 4 hour have given you the bias. This is not what, I'm not teaching you the bias today, okay? So we'll explain that another day. The daily and the 4 hour have given you bias. You then move to the 15-minute or the 5-minute, okay? For IFVGs / AMD, okay? So you want to use the 15 or the 5-minute time frame for your IFVG setups, okay? Now, this is literally just dependent on your situation. If you work a 9 to 5, you know, are really busy and don't get much time to look at the charts, what you want to do then use the 15-minute, okay? It's that simple. Like, using the 1 minute is a bit crazy, but if you work a 9 to 5, are really busy and don't get much time to look at the charts, you know, you can only really glance through it on your lunch break or something like that, use the 15-minute time frame. That works too. But if you're serious about it, you want to become a full-time trader, if you have a lot of free time or can make a lot of free time, use the 5-minute. Because the only reason I'm saying this is because when you're managing your trade, it's going to be a lot easier to manage your trade in a 15-minute time frame when you're working a 9 to 5. But if you have a lot of free time and you can look at the charts, then it's going to be nice and easy to trade the 5-minute because you can look and make adjustments very, very quickly. You're not going to get caught up in meetings. You're not going to get caught up with your kids, whatever it is. If you have a lot of free time or you can make a lot of free time, use the 5-minute time frame. If you don't get much free time, use the 15-minute. It's literally that simple. Now, me personally, what time frames do I use? I use the daily, the 4 hour, the 1 hour, the 15, and the 5-minute, okay? But I typically will trade on the 5-minute, okay? Now, don't focus on the time, okay? I'm just showing you the entry, okay? Specifically just the entry point here, okay? Just the entry. All you really want to do is take your entry after the first inverse fair value gap is formed, okay? Literally that simple. Place your stops above it, but you want to keep your stop loss 2 liquidity zones away. So you do something along these lines like this, okay? And that is literally it. I know this is through Asian session, but I want you to just focus on the entry. I'm trying to just teach you the entry here, okay? So the steps for the entry, now once you've picked your time frame, is number 1, wait for good price action, in brackets, accumulation. Okay. Number 2, wait for manipulation. And you know how all this works, either into IRL or taking ERL. Here, we manipulated into IRL. We came into a fair value gap over here, okay? Now, wait for the fair value gap we formed during manipulation to be inversed. If you want to write it down step by step, this is how you write it down. Wait for good price action, wait for a manipulation either into IRL or taking ARL, wait for the fair value gap we formed during manipulation to be inversed, take your entry, targeting ARL/IRL, okay? So, as I said, the characteristics are different for every single distribution cycle. Sometimes you'll be catching distribution towards a fair value gap using higher time frame ARL to IRL. Sometimes you'll be using distribution towards lows using IRL to ERL, okay? But you know IFVGs, you know ERL and IRL. All you need to do is find the right session, which is London or Asian or London accumulation. Wait for that manipulation to occur into ERL or IRL, form a fair value gap, wait for that fair value gap to be inversed, take your entry targeting ERL or IRL. Literally that simple, okay? That is how you take the entry, okay? So here, using that, we take the entry targeting ERL, okay? Now, in terms of managing the trade, there's multiple things you can do. First, we need to look at setting the stop losses and stuff. Exiting the trade, okay? We already know TP, ERL, IRL. Or sometimes you can learn to put it at just the other side of the accumulation range. Now, you'll pick up on that as you learn to trade. And as you learn to use this, you'll know when and when not to do that. And then the stop loss simply goes 2 liquidity zones away. That's pretty simple. You can have a soft stop loss and keep it very, very close and have a soft one. Or you can just keep it 2 liquidity zones away. Now, there's pros and cons of each, okay? What's a soft stop loss? A soft stop loss is where you basically say, I'm going to close the trade at this level, rather than like having a actual stop loss at that level. You just wait for the candle to close, and then if it closes like that, you can then close the trade, okay? But the issue with that, issues with a soft stop loss, is you can get caught in like bad moves. You can lose a lot very quickly. Okay, that's why I don't use them. Now, how I do it, there are cons to it. Issues with keeping SL 2 lick away is you get on average a lower R. But you don't actually run that risk of having this. And also, when you're trading with prop firms, some prop firms will require you to have a stop loss and will refuse payouts if you don't actually have a stop loss in some of the trades you take, and other things like that. But issues with a soft stop loss is you can lose a lot very quickly. Issues with keeping stop loss 2 liquidity zones away is on average a lower R. But why is it 2 liquidity zones away? As you guys know, I've shown you what a stop hunt is. So keep SL 2 liquidity zones away from price. And this can be in the form of ERLs and IRLs. So ERL or IRL, so it can be above a fair value gap and above a high, and that would count. But this is why we do that, is to avoid being caught in a stop hunt. Now, there are multiple ways to do this. You can use ATRs, you can use soft stop losses, but I just simply do this. It's a lot easier. You don't need the indicator. You don't need a soft stop loss, which is bad because you can lose a lot. I've been burnt from that. So I just keep it 2 liquidity zones away, and that's what I want you to do as well. So this is IRL, this is ERL, liquidity zone 1, liquidity zone 2. We would have to inverse this and then come up and take the high if we're going to continue up. So you just put it there, and then you put your TP at ERL, and you can look to manage the trade once we take the other side of this range, okay? And, you know, as you can see, very, very straightforward. But that's how you want to trade. You would look to adjust your stop loss, you know, once we've come down here and took this low. And you'll pick up on this as you trade. Like, you'll learn to manage the trades. You'll go, well, we've got a fair value gap right here. We've just took out a low. So, like, let me just zoom back. So if we go back to this candle here, okay, we go, okay, so we've just took a low here, yeah, left behind a fair value gap. We would have to inverse this fair value gap, take out this high, and then continue up. So all you have to do really then is just put your stop loss above here, okay? Then it's 2 liquidity zones away, and then you just let it play out, basically. You can look to take partials at the other side of the accumulation range. Sometimes I look to trade there as well, and that's pretty much it. Like, that's how you want to trade it. Okay, I think here's another example, okay? So this is a trade I would take as well. Okay. So first things first, we have all this low, all these lows over here taken out, okay? All these lows to the left-hand side, okay? And if we go to a higher time frame, like the 1 hour, you can see this is the ERL, okay? So we come down, okay? And then we retrace, after taking ERL, we come back to the fair value gap, which is over here. See that? So we take the low, ERL, come back to IRL, respect it, inverse this fair value gap here, entry. You know, I'm going to draw it out for you just so you can see it. We have the accumulation here, then we have the manipulation and the distribution to the downside, and it's literally that simple. Okay. There you go. These are trades you would want to take, okay? And if you want to see me taking these trades, you can go back to my live streams and wait for my next one. My next live trading stream where I'm trading, I trade every single day live. I'm on a break at the moment because it's Christmas and New Year's. But I'm back live again on the 21st of January where I trade this every single day in front of people, okay? And I also do have a stream journal. I think it might even be linked down below if you want to check that out eventually. But there is a stream journal here, basically tracking every single trade I take. But yeah, that's pretty much it. So I hope everyone understands that at the moment. Now, we've covered everything we need to learn. We've looked at AMD. We've looked at accumulation, manipulation, distribution. We've looked at AMDX, AD, good and bad price action, using it to actually take trades. And that's pretty much it. What side of the country are you in? I am from Liverpool in England, so north. Now, the common mistakes of this is entering too early. Okay, you don't want to do that. There's ignoring the session timing, so make sure you're looking at the timing, because time in trading is key to near enough everything, because it shows you when there's going to be more volume. Now, you don't want to fall for a fake manipulation as well, which is when we're not taking ERL and we're not coming into IRL. And then you want to also make sure you're not ignoring ERL and IRL. All these 4 points are big mistakes that I've seen a lot of people make in my time teaching people how to trade. They do this. These are the 4 most common mistakes when people are trying to trade this strategy, okay? So, we've near enough got that out the way now. I've shown you IFVGs in the first lecture. I've shown you IFVGs and liquidity. In this lecture, I've shown you AMD and how to bring those two things together. So now you should be able to go and take these trades on your own on a daily basis. So by the time Monday comes around, if you've done some back testing, if you've got the practice in between now and then, you should be able to trade this properly. You should also be able to journal the trades you're taking, review what you're doing wrong, and stuff like that. So if you're actually looking to take this seriously and you want to learn to trade like this, all you need to do really is journal your trades and send them into the Discord. That is literally it, into the free Discord, which is the first link in the description. All you need to really do is journal the trades you take, send the trades you take into the Discord and ask for feedback, and you will succeed, because people in the premium group will give feedback to you, and I will also give feedback to you as well. So you'll know what you're doing. But if you're looking for key takeaways from this lecture, AMD is the way the market moves. Very, very simple. But what is it, first of all? We need more Mandem on the live stream. Yeah, we do. Like up the stream, guys. Share the stream. Whatever it is you need to do. Like, share, subscribe, spam in the chat. Whatever it is you need to do to get more people in here, do it. Once we hit 100, we unlock the biggest giveaway I've ever done. Okay? But what is the daily bias? So, daily bias is a roadmap to predict market direction for the day. That's all it is. You can have a longer term bias. You know, like you can be bearish on a market. Like a lot of people are bullish on Bitcoin now. That's not a daily bias. That's like a very long term bias. A lot of people are long term bearish on long term bullish on crypto. That's not a daily bias. A daily bias is what you look at for that specific day, for that specific session that you are trading. It's a daily or it's a session bias. It's got two names. And what you need to do is you need to align those trades. Once you've found your bias, you align the trades with the institutional intent and the session timing in order to actually win most of the trades, okay? Now, I think one thing is a lot of people struggle with daily bias because they struggle with the actual concept of ERL and IRL. Now, all daily bias is using ERL and IRL. To establish a daily bias, which I'm going to show you in a minute, is simply just using the daily and the 4-hour ERL and IRL. Now, there are slightly different rules to the ERL and IRL and how you identify the direction the market's going to go in, and I'm going to show you that because obviously price can consolidate. That's one thing that a lot of people have struggled with. Like, how do you actually use ERL and IRL during a consolidation? We know that it's we know that it's an accumulation phase of AMD, but how do we actually deal with ERL and IRL in terms of a consolidation? And that's one thing a lot of people are going to struggle with. When I'm going to show you how to identify a daily bias, but one thing that will be difficult for you is actually using that daily bias in a consolidation phase, in an accumulation phase on the higher time frames, and I'm going to show you exactly how to deal with that as well. That's probably going to be one of the biggest learning points of this lecture, regardless of psychology. So we're going to be looking at that as well. But basically, what you want to do for daily bias is identify liquidity zones, fair value gaps, and simply put, just use ERL and IRL. I'm going to show you a few examples of what I mean and a few examples of how consolidations work, okay? So let's just jump straight onto the charts. This is the daily bias example. So we just got GBP, JPY, and we can do this on a bunch of different time frames. Oh, shit, we almost at 100. 100. Oh, shit, 102. Get in, guys. This is crazy. Oh, my days, 102. This is absolutely mental. 100 viewers whilst live. This is crazy. Oh my days. Let's see. Let me just refresh on my phone. 103 viewers. This is absolutely mental, guys. This is absolutely crazy work. Oh my days. Well done. So yeah, we have officially unlocked the giveaway, as I was about to show you daily bias. Now, in terms of the giveaway, we're going to be doing that at the end. You've unlocked it now. It is happening. It's a thing. All you need to do to win is stay in this stream. At the end of the stream, I'm going to be showing you exactly what the giveaway is. And you need, basically, to win, you need to stay in this stream if you want to get access to it, okay? 103 people whilst live. This is crazy, guys. That's a record for me. I'm very happy with that. That's crazy. Let's see how we can maintain this. W's in the chat, guys. W's in the chat. We've just on 107. It just keeps on going up. This is absolutely mental. Still going, guys. This is crazy. Oh my days. Spam W in the chat, guys. W in the chat. This is mental. We've unlocked the giveaway now, okay? We've unlocked the giveaway. We're going to be discussing what the giveaway is at the end of this lecture, okay? We've got it now. W in the chat. This is crazy. Yes, guys, this is absolutely mental. Oh, my days. Wow. Let's get it, guys. W in the chat. This is crazy. Yes. Oh, my days. Oh, this is cool, guys. This is why I do this shit, you know. This is why I do it. This is mental. Oh, my days. Wow. W in the chat. The giveaway will be done and decided and announced at the end of this stream, okay? Exactly how we did with all the other giveaways. We're going to be discussing what it is at the end of this stream. This stream shouldn't take too long, probably about an hour. Probably got an hour left, maybe, because it's not much to discuss. These W's are crazy, guys. Still going. Oh, my days. Oh, my days. W in the chat. You're buzzing about this giveaway. Over 20 people. Hundreds of people probably. Like, so many people are winning this giveaway. It's going to be mental, guys, okay? It's the biggest one I've ever done. You're going to be getting the most back from me in time for the course rebuild. It's going to be absolutely mental. W's in the chat. This is crazy. Right. Let's carry on with the lecture, right, guys? Okay. So the giveaway will be announced, decided at the end of this stream, okay? So if you want to know what the giveaway is, you want to know how to win, all you need to do is stay to the end of the stream, and that's where we're going to discuss everything about the giveaway, okay? Exactly how we did with the second lecture, Everything to do with this giveaway is going to be at the end of the stream, okay? But let's move on to crazy. Still going with the W's. Oh my days. This is mental. Okay, right. We're going to be moving on to the daily bias, all right? We're going to be learning exactly what daily bias is. This is crazy, guys. Oh, I'm so happy about this, you know. This is so crazy. Oh, guys, this is so cool, right? Let's get it. Okay, let's move on now to the daily bias, okay? We're going to move on now. Daily bias. Let's learn what daily bias is, okay? Let's stay focused on the goal of this stream, and that is to learn what daily bias is and psychology, obviously, but we're going to be moving on to daily bias now, okay? So, as I said, the steps to establish a daily bias is simply just go to the daily and the 4-hour time frame and then use ERL and IRL on that time frame. But there are a few issues with when price is consolidating. Like you can see here, we kind of had a consolidation. How does this work with ERL and IRL? How does this work here? You know, there's consolidations all over the place. And I'm going to show you exactly how they work, okay? Why they're important. But yeah, let's get into it. So, daily bias, okay? Note making time, guys, okay? Note making time, daily bias. How do you find a daily bias? So the first thing you want to write down for when you're identifying your daily bias is simply go to the daily and the 4-hour time frame. Okay, they're the two time frames you want to use for your daily bias. You don't want to use any other time frames. Now, sometimes you may go up a time frame to like the weekly, the monthly, and identify using that method, which I'm going to show you in a minute as well. But typically, the rule of thumb is to use the daily and the 4-hour, hence the name, the daily bias. Use the daily candles and the 4-hour candles, okay, guys? So you go to the daily, you go to the 4-hour chart, and you simply start at the most recent swing level. So go back to the most recent swing level. And work your way forward to current price action using ERL, IRL. Still spamming W, guys. This is mental. Right. Okay. So, how does this work? I'm going to show you a diagram, a perfect, perfect world example of me drawing it out, and then I'm going to show you exactly what I mean on the chart. So we go to the daily time frame, and the daily time frame would look something like this. So we have a nice downwards move, whatever it is. Okay. And the daily has just swept this liquidity and formed an imbalance over here. Okay, let's just say hypothetically that's what's just happened. Okay, excuse me. Right, so we go to the daily, we go to the 4-hour. On the daily, we see this. So this is the daily time frame. On the daily, we see this downwards trend. Okay, we go back to the most recent swing level, which let's just hypothetically say is this one. And if you don't know what swing levels are, they're basically the start of the moves ups and down. Okay, so when you see a downtrend, the swing levels are the top and bottom. When you see an uptrend, it's the same thing. It's the top and the bottom. Now, you have all these internal highs and lows, which are ERL, yeah? But you have the swing levels, which are the start and finish of each of these like trends, okay? So let's just say that we started a downtrend after this uptrend here, okay? So this is the swing high, yeah? So we go back to the most recent swing level, which in this case is the swing high, and then you work your way forward to current price action using ERL and IRL. So you go, okay, well, price almost took out this low. It didn't. It retraced to the fair value gap, respected that, then took out the low, then came back to the next imbalance, took out the low again, came back to an imbalance, took out the low again, came back to an imbalance, respected it, and then took out this low right here, okay? So we've worked. The reason I get you to go back to the most recent swing level, by the way, guys, is simply just because a lot of people struggle with actually where to start with identifying ERL and IRL, okay? And the easiest place to do it from is the swing level. So a few people struggle with actually where to start because we know like highs, and we know what ERL, IRL is. We know it's lows, highs, and fair value gaps, but a lot of people struggle with actually where to start, a starting point, a reference point for actually identifying what the next move will be. You can go back to the most recent fair value gap, but the easiest way to do it is go back to the most recent swing level, work your way forward, because this will build up your skill of actually using this concept. Once you're on, like my level or some people in the courses level, you don't really need to do this, but as I said, like when you're starting out learning what this is and applying this on the charts, you want to go back to the most recent swing level and work your way forward. So we've worked our way forward, yeah, and now we've picked up that price has just took out this low, okay? Price has just took... What's going on with these charts? Let's just go back over here. Let's go over here, okay. So, prices just took out this low, guys. Yeah? We got liquidity right here. And now, I want you to answer this in the chat for me, okay? So, prices just took out a low on the daily time frame. Do you think the next move is going to be bullish or bearish? What have we got to do? Have we got to go? Do we go down? Do we continue the trend? Is this a break of structure? Do we leave behind this fair value gap? Or do we retrace back to it before actually having any sort of continuation? What's the next move, guys? Is the next move likely to be bullish or bearish? Answer in the chat. Do you think the next move will be bullish or bearish? What have we got to do? Look at this trend. We take lows, come back to fair value gaps. It's simple, ERL and IRL. Do you think price is going to go bullish or bearish? Comment in the chat, bullish or bearish. Okay, a few people said bearish. But yeah, the majority are saying bullish. Exactly. Terence, bullish move up to go down bearish. Now, with that, Terence, we may not go down bearish, but we have got to have a bullish move first. So the answer is bullish. The answer is bullish, guys. That is correct. Everyone, near enough. Few people said bearish. Now, we may continue the trend down. Okay, we may continue down like this. And that is bearish. But we've got to have this retracement first, okay? We've got to have the retracement. Because in order to continue the trend, we got to retrace. But also, it's simple ERL and IRL. We take out liquidity, then we go back to fair value gaps, okay? The exact same thing we did on this whole move down. We take out a low or a high. In this example, we take out a low, then we retrace back to the fair value gap. Retracing back to the fair value gap in this example is bullish, okay? So then we go, well, if the next move on the daily time frame is bullish, it might just be the smallest bullish retracement ever. Like, it literally might just even just be like this, like literally just this, and then continuing down. But that means for that day, we're expecting the next few candles to be bullish. Because if we use ERL and IRL, we know that price is going to go bullish for the next few candles. Then we go, okay, well, this is the daily time frame. So if the next few candles on the daily time frame are supposed to be bullish, that means that the bias is bullish. Or in other words, the next few daily candles will be bullish. Or in other words, the next few days will be bullish, okay? The reason it's bullish is because we took out the low, so we retrace back to a bearish fair value gap. And that's it. Now, from there, from that point, we don't care what can happen after it at that moment in time. We don't care if we respect it and continue down. We might do that, and that will be bearish. We may then obviously push straight through and be bullish, taking out this high, etc. We don't care what's going to happen once we get to the fair value gap. All we know is that we've got to come back to the bearish fair value gap now. And in order to come back to the bearish fair value gap, what have we got to do? We've got to have a move up, okay? So the next few candles will be bullish. In other words, the next few daily candles will be bullish. And then you can put that down or funnel that down and go, basically, the next few days will be bullish, okay? So that gives us our bullish bias, and that is literally it. Now, you want to basically go to the 4 hour and confirm this. So write this down. Once you've identified the next ERL, IRL move on the daily time frame, excuse me, you want to go to the 4 hour, okay, and apply the same concept there, okay? And this is where the bias part of it comes into it, because we know that the daily is going to be bullish. Okay, we know the next few daily candles will be bullish, or they're supposed to be bullish. But what we want to identify is then kind of like the session bias, because okay, well, if the day can be bullish, but what about the time that I want to trade? So whatever time of day it is that you log on to the charts, it can be Asian session, London session, New York session, I don't care. Whatever time frame it is that you log on, you then just want to look at the daily and go, okay, well, the daily's bullish. And this is the thing, because if you log on, okay, let's say you trade Asian session, you log on, you see that the bias is bullish, yeah? Then someone else in New York session sees that the bias is bullish as well. And then someone in London session sees that the bias is bullish. If you just use the daily candle, that means that we will be bullish in Asian, bullish in London, bullish in New York. And you should know for a fact the price just does not work like this. It just doesn't go straight up or straight down. And when it does, it's more than likely a fake out or a retracement's due. So when we push straight down or straight up, it's pretty unsustainable, and it's pretty rare that this will actually happen as well. So then we go, well, if it's pretty rare that we actually push straight up or straight down, we can't really conclude that this is the bias we want to look at all day, can we? We can't go, we just want to take bias all day, because all the price is going to do is go up and up and up and up and up and up and up. We don't know that for certain, and also it's not really reliable to trade that. So what we want to actually look at is the session bias that we're going to trade. So when you log on, if it's London, if it's New York, you might be looking at a different 4-hour candle, and that's perfectly fine. But all you need to do is apply the ERL and IRL concept on the 4-hour time frame, okay? And what that will do is that will give you that bias for that session. For example, okay, so we know that daily is bullish, okay? So daily equals bullish. We go to the 4-hour, and we see that the 4-hour candle has just took a high out, which means it's technically bearish there, okay? So if it's bullish and bearish, well, it's kind of mixed. Okay, mixed bias. And in that case, you can kind of just trade in any direction. And that, you know, that kind of defeats the point of finding the bias. But this is why you want to look for the bias, because what will happen is you'll know that the daily bias is bullish. Yeah, if you just looked at the daily bias, or if you just didn't look at a bias at all, okay, what will happen is you will obviously blindly trade. But if you know that the bias on the daily is bullish, the bias on the 4-hour is bearish, we have a mixed bias, then you know to be extra cautious with your trades, okay? So it's more important than ever to actually look for those confluences you're supposed to have in the trade in the trade you're taking when the bias is mixed, okay? Now, that's a very basic lesson there. But what I want to show you, right? So, you know the other stuff. Like if the daily's bullish, if both are bullish, you can guess bias is bullish. If both are bearish, bias is bearish, okay? But the reason you want to look for the 4-hour, the reason you want to look on the 4-hour time frame is to give you that session bias, okay? So if you want to write this down, the daily gives you the overall bias. The 4-hour gives you the bias for the next few hours. And with this daily bias method, it can change quite quickly. It can change like multiple times throughout the day. But what this allows you to do is be able to actually trade the retracements of any trend as well as the actual trend. When we have moves like this, okay, we have a downtrend, yeah? Instead of just going, the trend is your friend, and trading like the actual bearish move and just only looking for sells, well, what you can do is you can go, well, we've just took out a low here, so we're probably going to start retracing soon. So you'd start looking for buys, catch the buy, come back to an imbalance, and you go, well, now we're in an imbalance, we're probably going to respect it and continue down. Then we come down, take out this, and then you start looking for buys again, okay? So your bias will change slightly more often, but you'll be able to catch not only the actual trend, but also the retracements inside of that trend. Because, as I said in the first lecture, the markets move by taking liquidity and offering fair value. That's universal on every time frame. So if we then apply that to the daily and go, well, the dailies took a low, retrace into the imbalance, we can then have a bias that allows us to trade not only the actual trend, but also the retracements, okay? Now, we have that out the way. We know that, okay? The daily gives you the overall bias for the day. But the whole day won't be bullish. We're not just going to go up and up and up and up, or straight down, okay? We will have retracements. And that's why we look at the 4 hour, because the 4 hour gives us our session bias, okay? Oh, sorry. I put session here. My mistake there, guys. I missed that. The daily gives you the overall bias. The 4 hour gives you the bias for the session, okay? That's why we look at those two time frames. Now we know how to look for those, okay? Let's just apply it to the charts. So let's look at this example. Let's just do this. And let's just pick a nice example. Let's pick here. Let's zoom in and see what's going on. So let's start. We're going to start over here. And I want you, this is going to be you guys telling me what the bias is, okay? So I'm going to mark a few things out, and then you guys are going to tell me the bias. So we have a swing level here, which is the swing high, because it's the end of this move, and it looks like it's the start of the downtrend. And we have the swing low all the way over here as well, okay? Which is the start of the upwards move and the end of that move. So we have the swing high. We work our way forward to the most recent price action, and we go, okay, well, we inversed this small imbalance here, took out the low, retraced, didn't have an imbalance to retrace to, formed one here, we disrespected it, okay, then we didn't form one here, we disrespected it, flowed around a little bit, came out, took these lows out, okay, so we've took out this low right here, get ready to answer this in the chat, so we take out this low, and we have this imbalance right here, okay? So I want you to comment now, what do you think the bias is going to be? Do you think the bias is going to be bullish or bearish? Bullish or bearish? Comment in the chat, guys. Is this bias going to be bullish or bearish? Catching a few guys out here. A lot of people saying bearish. A lot of people are saying bearish here. Okay. So you guys think the price is just going to continue down without retracing? Okay, a few mixed answers here. Someone said bearish overall and session bullish. Jovan, you're correct. Gustavo, you're spot on there. Okay, a few mixed answers here, guys. I'm not going to say you got that one right. Like, a lot of people at the start said bearish, seeing that I was judging them, and then started saying bullish. Okay, so bullish. Okay, a lot of people saying bullish now. Okay, so bullish is the right answer. Okay, but a lot of people said bearish, which I'm confused about. Okay, I'm going to walk you through this, and then I'm going to show you how it played out. Okay, so we have took out this low right here, then formed an imbalance. Okay, so from the close of this candle, we would be looking for buys. If we were here, and it was this day, we would then start looking for buys. Okay, we would be instantly bullish. Why? Because price does two things. It goes from liquidity to fair value gaps. One, it seeks liquidity, which it has done. It sucked out this low over here. Excuse me. Then it creates the fair value gap. So we've got to have a bullish retracement, which we do. We create the imbalance, and now price has to come back into that imbalance and then continue the trend. Or it will come to this imbalance, inverse it, and then continue up. A lot of people said bearish, but the bias is actually bullish because we want price to come back into this fair value gap, okay? Then once we come into this imbalance, we start looking for sells, okay? The second we come into this, the second we come into the premium zone of this imbalance, exactly how I shown you in the second lecture, or the first lecture, with premium and discount, the second we come into the premium zone of this imbalance is the second we want to start looking for sells, okay? A lot of people said bearish there. That's incorrect. The answer to this is bullish, and you'll see it play out now. So we did kind of have a bearish move down here. Then we came up, took out this, okay? Now, obviously, we did come down and take out these lows, which means a few people probably got stopped out here. But it's not right 100% of the time. I want you to focus on that. But we do come into this premium zone, and then we start trying to find like a bit of resistance. But a lot of people said bearish, okay? I'm not too sure why, because we take out this low, and then we look for price to retrace back to the imbalance. Literally that simple, okay? So we do that. Then we clearly respect this, okay? So I'm going to ask you again, what's the bias now? Is the bias, now that this candle's closed like this, is the bias bullish or bearish? Answer in the chat, is this bias bullish or is it bearish? Is this bullish or bearish? Geez, a lot of people, okay. Bearish. I've not seen one person say bullish. Perfect. Super duper bearish. That's right, Dan. Bearish, Elizabeth, correct. Alan, Jovan, Ghost, Little Legs, Gustavo, Chris, Harry, Junior, Metal Bat, Winfred, Arch, Dexter. Correct. Everyone is correct. I don't think I've seen one bullish. Gustavo. I'm not trying to name and shame you here, Gustavo, but it is bearish, not bullish. No one has said bullish apart from Gustavo. Sorry, Gustavo. Sorry. That's correct, Artem. Bearish, exactly. Bearish bias, guys. Bearish bias, okay? Come down and take out this low. Simple stuff, okay? Now let's do another example. So a few people were mixed with this. They weren't too sure what was going to go on. A lot of people said bearish at the start of that, and I'm not too sure why. Because we use simple ERL and IRL, and we look to come back to this this fair value gap. We come back to it, respect it, and then push all the way down. So you would have caught this move up and then this move down, even though a lot of people would have seen this as an overall start to a downtrend due to the lower highs and lower lows, okay? So you would have caught the whole move, every move, okay? Let's continue. Let's pick out another time, okay? So let's jump out of this. Let's have another look. So let's do over here. Right. So we've had this whole move down, okay? Leon, yep. Leon, you're correct. Right, so what's the bias here, guys? Okay, we're going to work our way through this whole move. Answer in the chat what you think the bias is. This is why we use the 4 hour as well. We don't just use the daily, because For example, if we were looking for buys here, you know, we would have got caught out. That's why we used the 4 hour as well. And I know that the 4 hour was saying bullish as well here, as well as bearish here, because I traded it live. But yeah, guys, what's the bias here? Here we are. We got a few answers already. Bullish, bullish, bullish. Correct. Bullish, 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 bullish. Everyone's got that correct. We got Harry, Jay, Abby, Azif, Alex, Chris, Gustavo, Jovan, bullish. Yes, yes, yes. Sweep, lick, end, rally. Perfect. Laura, Emma. Perfect. Justin. Wayne, yes. Everyone's got that correct. I don't think anyone said bear. One person said bearish. Not too sure where that came from. Yeah, bullish, bullish, bullish. Juan, Dexter, Langer, Maiden's Universe, bearish, bullish, as PD rate tap into info. We are bullish. Yes, we are bullish, bullish, bullish. Okay, so why are we bullish? We use ERL and IRL, okay? First things first, we have this right here. We got to come back to this, okay? Now, as I said before, once we come back to the fair value gap, it's a different story. We may continue down, okay? We may respect it and continue down, whatever. Or we may inverse it, continue up to take out the highs. I don't really care at the moment. All I know is the price has got to come back to this imbalance, okay? So, we have this here, and we have this here. ERL, IRL. Price goes from ERL to IRL, and then back to ERL. Okay, let's apply that concept now. Okay, we push straight up to this imbalance, okay? Now, this is where it gets a little bit messy, because we took out this high, okay? And we also respect this. So we look for sells, and this is where, like, this would be like the, I don't know, the 20% chance that it loses, where you get caught out here, because you would be looking for sells due to this. Then we inverse it. Then we push straight up. So now we've inversed it, okay? Let's start again here. Getting a little bit lost. Now we've inversed it. I want you to answer 2 questions now, guys, okay? I'm going to ask you 2 questions. Now we've inversed it. What's the bias? But where's the bias going to be going to? Is the bias to this high, or is it to this fair value gap? Do we have to come to this imbalance, or do we go straight through the imbalance and come to this high over here? So comment if it's bullish, comment bullish FVG or bullish too high, or if it's bearish, comment bearish and say why. So bullish and why. Is it bullish to a fair value gap? Is it bullish to a high? Is it bearish to a fair value gap? Is it bearish to a low? What's the bias, guys? Bullish to fair value gap, or bullish to high, or whatever. Comment in the chat, okay? Bullish up to the high, okay? A few people. Bullish to the high, bullish to the fair value gap, bullish to the high. Alright, okay, okay. Okay, most people got that right. It is bullish to the fair value gap, yep. I'll give a few more seconds for people to comment their answers. Ghost of Uchiha. Terrence, Lennon. First, Black Drift King, bullish to high ERL. Not necessarily. Bullish to the moon. Jovan, correct. Vicky. Wayne. Justin. Perfect. Bullish to this fair value gap, guys, okay? That is the answer. We are bullish towards this fair value gap. It's the same routine again. We will either come to this fair value gap, respect it and continue down, or inverse it and come up and take out the high, okay? Let's see how this would have played out. The answer is bullish to the fair value gap for now. We're not going to go up and target these highs. We're going to look at and see how price reacts to this fair value gap, okay? So let's see how that would have played out. Okay. So, we would have caught this, maybe got stopped out here, but would have caught this and this. Okay, as I said, the bias, no strategy works 100% of the time, so there are going to be outliers, like this candle right here. But all you need to understand is that like 80 to 90% of the time, the bias is correct using this concept. Now, we've come into this fair value gap here, okay? Now, it's too soon to say anything, okay? But if we use, let's just draw that middle line. If we use the premium and discount zone, and you remember what I said from before, and we go, well, now price is in the premium zone. As you can see, we closed, kind of respecting the fair value gap. Is the bias here bullish or bearish, okay? Is the bias here bullish or bearish? Answer in the chat. You don't need to really say why, just is it bullish or is it bearish?
Playing from Josh's iPhone 3.
Excuse me, guys. I was on my phone there. That was my Alexa. Emma said neither, really. Abby, Wayne, Gustavo, Dalen. Jovan said bullish. Adil, bearish. Azif, Big Deeds, Terrence, Jonathan, Alexander, Ezra, Chris. Ezra said bullish as well. Okay. Dexter, bearish. Juan said bearish to look for liquidity. Okay. Okay. So, this is where it's going to catch a few people out, okay? A few people have said bearish, a few people have said bullish. Let me show you the answer, okay? So, we have the premium zone. We know price, that's where price is going to reverse. The best place to look for sales is the premium zone, PD arrays, all that stuff, yeah? Now let's zoom into this and go, well, we've just took out a high here, yeah? Okay? And we've come into the premium zone. Let's see how the next candle plays out. Okay. So bearish is correct, by the way, because of that. We also have this imbalance right here, okay? So let's just delete this fair value gap for a second, okay? Completely forget about that one to the left-hand side for now. Focus on this. Price has just took out a high, formed an imbalance, and now we've got to come back to that imbalance before we decide what we're going to do, okay? Okay, well, we come back into that. Now we start looking for buys. There we go, okay? Does that make sense, guys? Now we draw this back in and we go, well, we've inversed this, so we target the highs. Now, unfortunately, in this example, we did actually just push straight up, take out the highs as well as invert this. But I want you to follow the process of how we found this bias, okay? So it's bearish for 2 candles and then bullish literally straight after. And this is a perfect example of this like bias method playing out to a T, okay? Let's play that out again, okay? So, the bias is now bearish for 2 reasons. We took out the premium zone of this fair value gap. That's the best place to look for sales, the most expensive price. And now we have this liquidity right here, okay? So we took out a high and also respected a bearish fair value gap, okay? So we look for sells, catch a nice dub. Not only do we have equal highs here, but also we have this imbalance that's formed right here, which I'm going to zoom in for people so they can see that. We have an imbalance right here. Now let's delete this big fair value gap and we go, well, ERL to IRL says we're due a bearish retracement because we take out the ERL, which is the high, and we retrace back to IRL, which is the fair value gap, okay? So we come back to that fair value gap. Now we start looking for buys, okay? And then we draw this in again. So now we start looking for buys. Coming up, it's back to ERL to take out this high, okay? Boom. Now, once we close above this fair value gap, that counts as what? An IFVG, which means the price is then going to go to the other side of ERL. So we take out this IFVG, or sorry, we take out the fair value gap, form the IFVG. Therefore, we then want to target the highs. Now, unfortunately, in this example, we did end up taking out the highs, okay? We may continue up, though. But as you can see, we do end up pushing straight down after taking those highs. We then retrace, and you can see how it plays out. So here we have the fair value gap. We form on the way to take out these lows. We inverse that fair value gap, take out these highs, then reverse back down, come down, take out these lows and these lows. So now we would start looking for buys back up to this imbalance over here. I think this is the end of the back testing now. We'll see how it opens on Monday. But that means for Monday, really, we would want to look for buys back up to this imbalance over here, maybe even this one. But for now, we just want to target this one, okay? The exact same way we just did with that bullish move up. But yeah, that's how you want to find your bias, guys. It's literally very, very simple. Okay, now the notes for the bias. 1, or how to find a bias. So new subheading, guys, how to find your bias. Step 1, go to the daily time frame, obviously. Then go back to the most recent swing level. Go back to the most recent swing level. And you know what those are as we've discussed them. Okay. Start identifying ERL, IRL from the most recent swing level. Once you've got the daily, so once you have the daily, go to the 4-hour. And do the same thing. Okay? Now there's 3 possible outcomes for this bias, obviously. So first of all, there is a mixed bias, okay? Mixed bias. And this is when you want to rely really on oh, nice to see you here, Ryan. Nice to see you here, Ryan. How you doing? So if there's a mixed bias, what you want to do really is that's when you want to rely on the middle time frame structure. So as we spoke about in the first lecture, middle time frame structure is like the 1 hour. So rely on MTF. And that's because the bias is slightly mixed, so we don't know if it's going to be bullish or bearish, but what we really want to find out is if the next few hours of when we're looking for a trade, whether or not that's going to be bullish or bearish. So but rely on the middle time frame, okay? In brackets, that's like the 1 hour time frame. Maybe the 2 hour. I don't really use the 2 hour though, but rely on the middle time frame, which is the 1 hour, the 2 hour, okay? And trade with that. Then there's obviously bullish, bearish, you know, we don't really need to go too in depth in that. Pretty self-explanatory, but how to find the bias, this is what you do. These are the outcomes. If there's a mixed bias, you want to rely on the 1 hour or the 2 hour time frame and trade with that. Basically just do the same thing on there, and then obviously if we're bullish, bearish, you know what to do with that. Thanks, Ryan, appreciate you. Yeah, like up the stream, as Big Deeds saying, you know, Big Deeds, like up the stream. So that's what you need to do, guys, okay, to find your bias. Now, as I said before I started to show you the bias, there are a few areas where ERL and IRL might be a little bit blurred, okay? So this is where we need to look at consolidations, and I think we might have touched on this in the last lecture. I'm honestly not 100% sure, but very, very simply put, after a big move, okay, we will consolidate. Okay. After a consolidation, we will have a big move. That's what you want to write down. Okay, so the reason that is you know, it's like take profits, cooling off. Plus also, then you look at the volume and you go, well, in Asian session, we don't really have a move as often as we do in New York or London, simply just because of the volume. But I'm going to show you exactly what I mean on the charts. After a big move, we will consolidate, and after a consolidation, we will have a big move, okay? That's what I want you to understand, and I'm going to show you exactly what that looks like on the charts, and then I'm going to show you exactly how to deal with a consolidation with your bias, okay? Or for your bias. Okay, so let's have a look. So, to understand this, first we need to go AMD. Okay, what a distribution is a big move. Okay, what happens after distribution? We typically go back to an accumulation. Then what happens after an accumulation? We manipulate and then we distribute, okay? Sometimes we will have AMDX. I know, I've even shown you this in the last lecture. We discussed AMDX, and that's where we go from a distribution to an expansion. But what happens more often than not is AMD rather than AMDX, which means, okay, oh, excuse me, which means, okay, write this down. It is easier to catch a big move after a consolidation, hence why I trade AMD, rather than catching a big move after a big move, okay? In brackets, continuation, okay? It's a lot harder to catch a big move after a big move because of this simple reason. AMD occurs more often than AMDX, and if it was the other way around, and if AMDX occurred more than AMD, I would not be teaching you AMD as a basic starter point. I would be showing you AMDX, okay? So AMDX can happen sometimes, and that is the outlier. As I said, nothing works 100% of the time. The bias I use never works 100% of the time. AMD never plays out 100% of the time. It's never just 100% of the time AMD. Sometimes we will have AMDX, sometimes we will have AD, as I've shown you in the last lecture. But what you need to understand is probability. That's the whole reason we trade. That's the whole ideology of trading, is that it's all in probabilities, okay? The probability is that AMD will happen more often than AMDX. Therefore, it is easier to catch a big move after a consolidation than catching a big move after a big move, okay? I don't know if that's shrugged shoulders there. But let me show you what I mean, okay? So, let's look at just this entire chart, okay? We can look anywhere we want and you will see it everywhere, okay? So, we have a massive move down, yeah? Then we retrace and consolidate, okay? Then we consolidate, push down, then we push back up, which would technically be the X phase. Then we have the consolidation, then we push up, then we consolidate, then we push down, then we push up, and it looks like we're starting to consolidate with this bullish bias that we're due in a few days. That's just one example of the most recent price action. Here it is again. Move up, consolidation, move up. Then we have the X phase, as I said, which is the outlier. Then we have all this here, so we push up, consolidate. Okay, push up, consolidate, push up, and then kind of mess around here, but then consolidate. Okay, here we consolidate, then we push up, then consolidate, then push down, then consolidate. Okay, we consolidated here after pushing up. We consolidated here after pushing up. Okay, like we can go on all day. Okay, we push down, consolidate, we push up, have a small consolidation, push up again, have a small consolidation, push up, consolidate, like push up, consolidate. You know, we have a massive consolidation range here. But here's an example of AMD on the daily time frame, right there, with an IFVG entry. Here we push down after a consolidation, push back up, then consolidate. Okay, then push down, push up all the way, slightly retrace, but then consolidate. Okay, then we push up again. Have a like I can go on all day, but I'm pretty sure you understand the point. Like, just look at this. Okay, that's just on GJ. Okay, so if you didn't believe it already, after a big move, we're more likely to consolidate than reverse, than continue / reverse. Okay, now sometimes we will reverse. As I said, not every single time we will just continue. Not every single time we will just start accumulating again, but typically we will consolidate after it. Hence why we trade AMD, hence why we trade power of 3, hence why we look for times of volume, and all those other little bits. Sometimes we will have a move like this where we push up, then push down, but then we will always just consolidate. Okay, so realistically, the best place for you to look for reversals is consolidations, because if you go, well, actually, I'm going to look for a continuation every single time, and then you go, well, here you can see, let's look for let's look for a continuation over here, okay? After pushing down, it's not really going to work. Now you can catch the retracements, okay? And we would have caught the retracement, especially on the daily time frame. But you do the same thing here. We go, okay, well, let's catch a continuation or a reversal, okay? Then we consolidate. Then we push down, reverse, consolidate again. So all you need to really do, and the way it's going to be the simplest and the easiest way for you to trade, is simply just wait for a consolidation. Like, that should be pretty well understood by now. That's why we trade AMD. But what I want you to understand is that, like, that's that concept out the way. But when we are consolidating, okay, I want you to write this down too. So when we're consolidating, ERL, IRL may play out a little bit differently, and it won't be that the principles are different. We will still go from lows to fair value gaps and then to highs, vice versa. It's more that it will get harder to identify. It will get harder to identify. And sometimes what you'll notice is, sometimes we may not even have a fair value gap. Okay? Like if we go back to this, where is a good example? Here, over here. Like, look at this consolidation, okay? Right here, we don't really have any fair value gaps to use. You see? Like, there's one here. We inverse, then take out the low. But then we don't really have any more. Okay? So what do you do? And I was explaining this to someone today. So, when you see a consolidation, when you're looking for your bias, okay? Write this down too. When you're looking for your bias, and you see a consolidation, specifically one with no fair value gaps inside of it, specifically with no fair value gaps, you want to move time, change time frames. You want to go up a time frame, okay? So what will happen is, for example, right, if we're using the daily, if we use the daily time frame for our bias and the 4 hour, and we're consolidating on the daily, you want to use the weekly, okay? And when we do this, using the middle time frames becomes extremely, extremely important. Okay, write all this down. So if we use the daily and the 4 hour, and we're consolidating on the daily, then use the weekly, okay? Use the weekly, excuse me, and the 4 hour. Okay. Then when you do stuff like this, it becomes extremely important to use the middle time frames. And this can work all different types of ways. The 4 hour might be mixed, so you go up to the daily and the weekly. The daily might be mixed, so you use the 4 hour and the weekly. But whenever you use this, you want to make sure you're using the middle time frames. Why the middle time frames? Because the middle time frames, they show you exactly what's going on for those next few hours, okay? Okay, so it's very, very important to use the middle time frame when that happens, okay? So if we go back to this example, this is when you'd want to use the middle time frame. We go, the daily's consolidating. What does the weekly look like? Well, okay, I think this is glitched, but this is the same idea, okay? I don't know why it's done that. What I was trying to show you was that the weekly needs to come up and take the high after respecting the fair value gap here. Okay. And that wasn't even cherry picked, like, you just know how it's going to look. We were supposed to do that. I don't know why it's closed up that, because if we go back to the daily, you can see we're clearly not at a new high. But as you can see, we respected this, so we'd look to come up and take out this high over here. Okay. So then you use the weekly, but then for your actual entry and etc., that's when you'd want to use the 4 hour, okay? That kind of ruined the example because it just jumped to the end of the week. I'm not too sure why. But yeah, you can see basically on the daily, it's kind of consolidating. But after this point in time, you would be bullish because you would be coming up to try and target these highs over here, okay? Then we take those highs out, and then we get out of that consolidation range, and then that's when you'd want to look for the retracement, and then a continuation, okay? So that's how you find your bias. I hope that that's understood. The way you want to find your bias is going on the daily, going on the 4 hour, looking for your ERL and IRL. If the daily or 4 hour, or let's start again. You go to the daily and the 4 hour, okay, and look for the ERL and IRL. If one of those time frames is consolidating, move up a time frame, and that's when middle time frame structure becomes even more important. If it wasn't important already, which it should be, then now more than ever is the time to actually rely on the middle time frame structure, okay? So you want to use the daily, the 4 hour. If one of them's consolidating, move time frames and get out of that consolidation, because then you will see a bigger picture and you'll see what's likely to happen in slightly longer term, but it will give you a bias, and then you use the middle time frame for that shorter term bias as well, and align those two things together. And yeah, the second point that I made there with the consolidation and using the higher time frame and then relying on the middle time frame, that might be a bit confusing, so it's very important you write that down. But also, I've shown you it, and now all you really need to do is backtest that and trade that, and the more you apply it, the deeper you'll understand. On a deeper level, you'll understand it, okay? Or you'll understand on a deeper level, okay? I do not use order blocks. I do not use order blocks. You do not need them. Or breaker blocks. Right, so that's how you find your daily bias, okay? I hope everyone understands how to find the daily bias. Now we need to just basically look at psychology. So precision trading framework. This is the framework that you should be following when you're taking a trade, okay? You identify the liquidity zones, look for an AMD manipulation phase, then confirm direction with that time frame, IFVG entry model, all that stuff that I've shown you from the past couple lectures, and align it with the daily bias for that precision setup, for the precise setup, okay? That's it. Like that should be your strategy at the moment. And before we move on, the giveaway, we have hit the goal, obviously quite early on in the stream. That's going to be at the end of this. All we need to cover now is psychology. Once we cover that, we're looking at one example on the charts, and then we're going to do the giveaway, okay? So, precision trading framework, this should be the framework you use. But now we need to look at psychology, okay? Excuse me. So, why does psychology matter in trading, okay? 90% of trading success is mental. I can give you all of the source. I can give you all of the tools to use, all right? But unless you can actually use them properly with the right psychology, you're not going to get anywhere, okay? You can have... I could give you the best strategy in the world, $1 million in funding, and I can literally sit next to you whilst you take your trades. But if you don't have a good psychology in your trading, you're not gonna be able to succeed. Okay, not only do you need a good strategy, but you need a good psychology as well. Now, psychology can be quite boring. I know a lot of people find it quite boring. Sorry, and I know from my perspective, it is quite boring because when I make videos about it, they get less views than other videos, which means most people don't watch it. But it's very, very important this. You can have the right strategy, but without the right psychology, none of this matters. And I'm not just going to be showing you the baby stuff here. I'm not going to show you FOMO, greed, all the basic things that you've definitely heard of before. I'm going to show you a little bit more advanced stuff and how to deal with those things, okay? So 90% of trading is emotional. It's all mental. Sorry, is mental. 90% of trading is mental. There we go. Your emotions and habits shape your decisions. Okay, in and outside of trading, and that's why discipline comes into it quite strongly. And in the course as well. If you've watched my actual course, you'll know that I talk about discipline quite a lot, because discipline outside of trading translates to discipline inside of trading, and not insider, inside of trading. And it's very important to have good discipline outside of it, because trading reveals literally everything about you, especially when you're using live real money, funded accounts, or funded challenges. If you're someone who, if you lie to yourself, if you cope all the time, you will cope and lie to yourself in trading. It's very, very raw in terms of that aspect, but there is a lot of fear as well in trading, and there's a lot of lack of confidence. We're going to be covering that as well, but mastering your psychology creates consistency and confidence, okay? Now, you don't have to answer this question in the chat, but just think to yourself, how often do your emotions influence your trades? How many times have you got into a great setup that you think is perfect? You don't have to answer this question in the chat, but how many times have you exited a trade for the wrong reasons due to emotional influence, okay? Due to your emotions. How many times has your emotions influenced the trades? How many times have your emotions influenced the decisions you make inside a trade, okay? You just have to think about that. Like, I'm sure most people here can agree that a lot of the time, the trades you take are impacted by the emotional decisions you're making based on the trade you're in, okay? You'll take a trade for no reason. You can close a trade too early for no reason, just because your emotions. You can get in for FOMO. You can get out because of FOMO. You can lack confidence and close it early due to a lack of confidence. You can see prices reversing away from your take profit. Get FOMO, think you're going to lose the trade. Also have a lack of confidence and close the trade early. There's a lot of reasons, okay? There's a lot of people will suffer from this, and that's why it's the biggest part, because it's not about the strategy. You can have the right strategy, but if you don't have good psychology, none of it matters, okay? I really want you to understand that. So the 3 things that I'm going to teach you today is adaptability, okay? And that is to the markets, also to the an issue with the psychology. So the problem is that markets change. What worked yesterday might not work today. Now, that's very simply put, but what I mean by that is the markets are changing, the world's changing, the economy is changing, the world is changing, okay? And the strategies that people used 50 years ago when they were trading Forex, believe it or not, it actually used to be a thing where in China or Japan, I think it was, all the housewives in Japan would trade Forex and make more money than their husbands. That's actually how really it kind of started off. Yeah, believe it or not, it was Japanese women, I think, Japanese housewives, and they were making more than their husbands. But the market's always changing, okay? What those Japanese housewives used to trade will not work today, and vice versa. Why does it happen? Well, there's institutional manipulation. Then there's also the institutional's point of view on the world. And then there's also volatility, okay? So markets change. Tools that you use change. Indicators stop working. Indicators start working. Strategies change. Strategies cannot stop working. Strategies can start working. Strategies can get better. Strategies can get worse, okay? So you have to adapt to changing markets. And the way you do that is by consistently backtesting. Like, I'm profitable. I'm making money from trading, and I preach that people need to backtest in order to get to this level. And that's right. But also, if you're going to continue and maintain this level, you need to also backtest different market conditions, okay? Like backtest the last time Trump was in charge, backtest the last election, backtest elections, backtest COVID, backtest the 2008 crash, backtest the 2000s, backtest 9/11, all these different things that change the markets and can just put a spin on things. Backtest them, and you'll pick things up and you'll go, well, when there's a presidential election, most of the time price goes more bullish and stuff like that, and there's more volume, which leads to more fair value gaps being disrespected, because the lower the volume in a market, the more that these support and resistance zones will be respected. That's a rule of thumb. So when there's more volume in the markets, and that can typically happen closer to elections as well, then fair value gaps are more likely to be disrespected. Okay, when COVID was going on, there was a lot more volume in the markets because a lot more people were trading, especially in crypto. A lot more people were finding out what crypto was. A lot of people were trading for the first time during COVID. I was one of those people. And that can influence how fair value gaps are respected. Believe it or not, it can influence how quickly liquidity is swept, how quickly we reverse after taking liquidity. There's a lot of different things that you need to pick up on. And what it will do is, it's not necessarily about writing it down and then spotting the outliers or the consistent failures. It's more about building that intuition of knowing these types of things, okay? And you will know them as you backtest markets at certain markets, okay? And when conditions don't match your strategy, it's very important to step back and backtest refined setups for the current environment, okay? No strategy, like the strategy I used last year is not the same as the strategy I'm using this year. It's similar tools, and that I mean literally like a year ago, not 2024 to 2025. I mean literally as the strategy I was using a year ago today is slightly different to the one I'm using today because it's been refined, okay? And that's always going to be happening. Anyone you learn from, anyone you see anywhere will always be refining their strategy, especially the actual consistently profitable ones will always be backtesting, always be refining their strategy for different market environments. That's what you need to do. But this is why it ties into psychology, okay? Because a lot of people will journal their trades and see that this specific thing loses, they'll spot these outliers, they'll spot these consistent issues within their strategy, and they'll think it's consistent, but it might only be over the course of like 10, 20, maybe 30 trades, and you'll have like a few consistent issues, okay? And the issue with that is that the reason that's psychology is because you're adapting too quickly. You're trying to beat the curve, you're trying to adapt, but you're doing it the wrong way. And the way I'd recommend doing this is every 100 trades, that's when you want to review your strategy. That's when you want to review your journal. That's when you want to maybe adapt something, okay? So I'm just going to go back to this so you can write it down, okay? When backtesting, when adapting to the markets, okay? You want to review your journal / adapt every 100 trades at least, okay? Like, think of it like this, okay? The better you are at trading, the more confluence you need to change the strategy, okay? What I mean by that is, picture it like this, okay? It's like a boat, all right? So when you're a beginner trader, you're in a boat, you're in like let's say you're in a speedboat, okay? You're a beginner trader and you're in a speedboat, and you can go off course, you can change direction very, very quickly. You can go, actually, because I'm a beginner, I'm going to stop using SMC and use ICT. Actually, I'm going to stop following that guy, I'm going to follow this guy because I'm a beginner. I haven't really got a consistent strategy that I'm using. I haven't really learned anything yet. So I can pick and choose. I can change direction. I can go wherever I want to go at the moment. But then as you get bigger in trading, as you're, making consistent income, as you quit your job, as you start, you like paying rent for a place to live based on your income from trading and all those different things, the decisions you make around your strategy have to become slower, okay? Then you start going from a speedboat to like, I don't know, like a fishing boat, and then you might go to like a full-on cruise ship, where if you're going to change direction, it requires a lot of effort and a lot of time, okay? Think of it like that. As a beginner trader, you're in a speedboat, you're just going dead fast, you can change direction whenever you want. The better you get at trading, the more you rely on trading for your lifestyle, the more time and effort it takes in order to pivot to a different strategy, in order to adapt to the markets, okay? So what you want to do, stick to a rule of thumb of every 100 trades at least. That's when you want to review. And when you are adapting and changing your strategy, okay? Changing a tool, you can remove them, you can add ones, you can change how you use them, whatever it is. When you're adapting, when you're changing, make sure, this is very, very important, to only really change one thing at a time. Okay, and the reason for that is because you could change 4 or 5 different things at once. Then your win rate decreases, and then what tool was it that caused that win rate to decrease, okay? You can change 5 different tools all at the same time, then backtest again for another 100 trades, find out that your win rate decreased, your profitability factor dropped, and then you go, okay, let's reverse that step. You have to literally remove all 5 tools at once, and then you start again, and you have to do each one individually to find out which one didn't work and which ones do work, okay? That's very important. So it kind of ties into psychology because a lot of people will do this too quickly. Can I draw? I think I can, can't I? Let's see. Yes, I can. Okay, great. So a lot of people will try and adapt to changing markets too quickly, and then that causes them to actually decrease in profitability, okay? Their win rate decreases. They change too many things at once. They change too quickly, and they have to then reverse it, and it just wastes time. Then you have to reverse it, then try each tool step by step for 100 trades, add it, remove it, change it, whatever. And that applies to especially more when you're relying on trading for your income. But that's part number 1 about psychology, okay? Step number 2 is simply too many decisions equals more mistakes, and this is called decision fatigue, okay? You may have heard me talk about this in my early days of doing YouTube and Instagram, etc. But what this means is basically the more decisions that you make, the more the quality of each decision you're making begins to deteriorate, okay? Like, obviously, once you're awake, the first decision you make, once you're awake, not the first decision you make straight from getting up, once you're awake, the first decision you make will be a lot better than the decision you make towards the end of the day. 1, because you'll be out of patience, but 2, because you won't be suffering, but you will be you will be decision fatigued. You'll have decision fatigue, okay? It's mental exhaustion from making too many choices, okay? You kind of get burnt out. You don't really know how to think. There's burnt out, but then there's also decision fatigue. Like, burning out is when you just don't make any decisions and you just kind of, your head hurts. And decision fatigue is when you can't think properly, even if you wanted to. And when you do think, it leads to impulsive or poorly thought out trades. And outside of trading, it would lead to impulsive or poorly thought out decisions, okay? So decision fatigue is mental exhaustion from making too many choices, and it leads to impulsive or poorly thought out trades, okay? Beware of that. Now, how do you deal with it? You limit your trading hours already, so that's why you should be trading only London or only New York, okay? And that's why also you should only really be focusing on 1 to 2 setups per day, okay? Because you will have more clarity. And now another thing, and this kind of depends on your life as well. Like, think about it logically, okay? There's one guy, and he's jobless, may not be making any money, but he's jobless, and he's, like, let's say, 18-year-old jobless, okay? Then there's a 34-year-old man who has a job, 5 kids, and a wife, and a house, and a mortgage, okay? He owns a business as well, let's say. So there's a 34-year-old man who owns a business and has a family, and then there's an 18-year-old boy with no family, no money, no overheads, no job, okay? Who do you think is going to get profitable quicker? Well, obviously it's going to be the 18-year-old. Not because of his age, realistically, but because of the amount of free time that he has. And it's not because of the amount of free time he has to dedicate towards trading, but it's more about the decision fatigue, because he's going to be making less decisions per day. Because as a married man, the 34-year-old guy will make decisions in his business, in his job. Then he'll talk to his wife. Then he'll talk to his kids, look after his kids, raise his kids, discipline his kids, discipline his employees if he's got any. There's all these different decisions that he's got to make. And then he comes home and then he's trying to trade. He's already going to be mentally exhausted. But then also you add all these bad habits on top of it, like trading all hours of the day and trading every single setup you see. It's just going to lead to mental exhaustion from making too many choices, leading to impulsive or poorly thought out trades, okay? So not only does it depend on your lifestyle and how much time you can actually dedicate to trading, but it also depends on these 2 things as well. So if you're someone who has a 9-to-5 and has kids, has a wife, whatever it is, if you have a family, if you're a grown person with a family, etc., you want to make sure these 2 things are perfect, okay? It's more important than ever that you focus on these 2 things, because you can't necessarily change your family. You can't not have kids anymore and not have a wife. Well, I suppose you get divorced, but you can't not have kids anymore, not have a business anymore, not have a job anymore, hopefully. So you want to focus on limiting your trading hours and focusing on 1 to 2 setups per day more than ever. But then again, if you're someone who was like me when they first started, who I had a job, but I didn't have many overheads, I didn't have a wife and kids, I didn't own a business, so I could dedicate more time to trading, but also I wouldn't be mentally exhausted every single day, then it's not too important to focus on these, okay? So it kind of depends on how much free time you have and how many decisions you're making, okay? Try and make your life as easy as possible, even if that means making hard decisions, okay? Because don't focus on how hard the decision is, focus on the amount of decisions you have to make. You want to make as little as as little decisions as possible every single day. And that will allow you to actually do better in trading, because you won't have mental exhaustion. You'll have better clarity, okay? Because too many decisions equals more mistakes, mental exhaustion, poorly thought out trades, okay? One trade a day will keep the 9 to 5 away. Exactly, Wayne. So you want to focus on this, guys, okay? I know it might sound boring, it might sound stupid, you might not agree, whatever, but trust me, okay? You have to trust me there. Too many decisions equals more mistakes, and you need to focus on this more if you're in a 9 to 5, etc., okay? Nice to see you, Gustavo. But yeah, so that's decision fatigue, okay? Now we want to look at metacognition, okay? You may not have heard of this term before. You may have heard of this term before. But think about how you think, okay? That's what I want you to do. Metacognition is awareness of your thoughts and decision-making process. So it's kind of like having a conscience. Like, we all have conscience, obviously. We have free will, etc. But metacognition, okay, is being aware of your thoughts. It's being like present in the moment, aware of your decision-making process, okay? Think about how you think. Why does it matter? Because it helps identify emotional triggers and biases, and it improves your self-discipline, okay? Like, it's going to be very hard to master this. Like, it's not just, with the daily bias strategy, with the AMD, with the liquidity strategy, I can just go, use this, and there you go, okay? But with psychology and this specific issue, it kind of takes a little bit more than just me going, do this. You have to kind of do it, and then and it's like a muscle, okay? The more you do it, the stronger that muscle will get. So the more you're aware of your thoughts, the more aware of your thoughts you will be. And that sounds completely stupid, but it's about how easy it is, okay? So if you're trying to be aware of your thoughts all the time, it will be a lot easier for you to be aware of your thoughts, okay? And that sounds very, very, very stupid, I think. Like, very easy to understand. I think anyone can assume that the more you think of your thoughts, the more you'll think of your thoughts. But think about the muscle side of it, okay? So the more you do it, the easier it will be to do so, and it will be easier to stay in that habit, okay? So be aware of how you're thinking, okay? It's like a muscle, and it's the same with discipline. Discipline's like a muscle as well. If you're not disciplined in when you're sleeping, when you're eating, like, it can go very, very autistic. You can be disciplined in what you're eating, when you're eating, when you're going to the gym, what you do in the gym, what time you sleep, what time you wake, what you do before bed, what you do when you wake up, what you wear. If you're disciplined in every single thing you can think of, and then you start trading, think about how easy it will be to then become disciplined in trading. Like, it's going to be very, very easy. But if you're someone who lazes around all day, addicted to all these different things, food, porn, games, weed, drugs, I used to be in that place. But if you're someone like that, it's going to be very, very easy for you to lack discipline when you go to trading. If you're undisciplined, if you don't have discipline in anything that you do you really think you're going to have discipline in trading, okay? Now, it goes the other way around. If you're disciplined in everything that you do, it's going to be a lot easier to have discipline in trading, isn't it? That's why it's like a muscle. But metacognition specifically helps identify emotional triggers and biases, because you can go, I'm thinking emotionally now. I'm feeling angry. I'm going to step away from the charts. I feel like I'm going to revenge trade. I'm going to step away from the charts. I feel greedy. I feel like I want to make money today, so I'm going to step away from the charts. And there's a difference between wanting to make money and then needing to make money. Like, you can wake up and then go on the charts and try and force a trade because you want to make money, or you can wake up, follow your plan, etc., because you want to make money. So that's a little bit of a different thing, but it helps you. Metacognition, on being aware of your thoughts, allows you to identify emotional triggers and biases. And that's why I say, especially with the bias, is to look at the fundamentals first. Now, I think I might have shown you, I'm not too sure if I've shown you what the fundamentals are. There's a video on my YouTube channel if you want to check it out, but it basically shows you how to look at the fundamentals, okay? Now, I want you to look at the fundamentals first, and it's very important that you do it first, because if you load up the charts and you go, oh, here's a perfect setup, but we've got CPI in 10 minutes, you're probably going to have a bias there, and you're probably just going to ignore that, especially if you're undisciplined in everything else you do. And then you'll just end up taking a trade, losing the trade because of news. But if you looked at the fundamentals first and go, there's CPI in 10 minutes, so I'm going to give it 20 minutes and then I'm going to analyze the charts. One, you've got discipline there, but also you're avoiding that bias and emotional trigger. So metacognition is being aware of your thoughts and decision-making process. It allows you to identify emotional triggers and biases, and it improves your self-discipline, okay? So what I want you to do, the kind of like the actionable step from this subject, is basically just after each trade, and it realistically, this is going to be useless. Like, you're not going to actually think about this much, but it allows you to then, as I said, like, build that muscle. So when you're thinking about your thoughts, it's going to be a lot easier to be aware of your thoughts in the moment. So if you're going, why did I take this trade after the trade, and what was my thought process after the trade? When you're in a trade next time, or about to take a trade next time, it's going to be a lot easier to just take that step away, identify the emotional triggers, and improve your self-discipline, okay? I told you this isn't going to be about like FOMO and greed, basic stuff. We're looking at metacognition today, and that's basically being aware of your thoughts. You can call it self-awareness. I call it metacognition. Like up the stream, guys, by the way. It really helps me out. If you've learned something new so far, like up the stream. Now, I've got a nice paragraph here, okay? Now, what I'm going to do is I'm just going to very quickly move the chat box so it's out the way. Screenshot this. Okay, screenshot it. And even pause it. Pause the stream if you want. And read this, okay? I'm going to read it out now for you. But make sure you got your screenshot. I'm going to give you a couple seconds to take that screenshot, okay? Okay. So, this is very important, okay? Psychology in trading can never be fully conquered because it's not just about strategies and setups. Excuse me. It's about mastering yourself in an environment designed to exploit your human emotion, okay? That's what trading is. And not only do you have the actual markets and the charts designed to exploit human emotion, but you also have the prop firms, which make it even harder to do. Okay? The market thrives on fear and greed, two of the most powerful drivers of decision making. And no matter how experienced you are, these emotions will always find a way to creep in. Okay? So think about it, alright? Even after years of trading, the temptation to chase a setup, the frustration of a losing streak, or the overconfidence after a big win doesn't magically disappear. I can tell you that from experience, and so can other people. The market evolves, as we discussed, and so do the ways it challenges your mindset. What sets successful traders apart isn't that they've beaten psychology, because that is literally impossible. You cannot beat psychology, okay? But what sets us apart isn't that we've beaten psychology, but that we've learned to recognize and adapt to it. We know when our emotions are clouding our judgment because of metacognition, and have systems to stay disciplined. Plus, you also have the muscle of discipline. Okay? Trading is a mirror. It reflects your patience, your ability to handle pressure, and your willingness to stick to your rules. As I said, it literally is, it shows you everything about yourself. Every trade becomes a test of your emotional control, and while perfection is impossible, progress is everything. You don't beat psychology, you learn to work with it, adapt, and grow as a trader and as a person. That's the real challenge and the beauty of this journey, okay? Make sure you read that. Make sure you write that down. I want you to understand that psychology is not a thing that you learn and then that's it. It's a process you always have to be working on. I have to be working on it still. I can get greedy. I can get fearful. Everyone, so it's a human emotion. It's not just something you deal with and it goes away. Okay. Beautiful. Yeah. So make sure you save that down, guys. Appreciate it, big deeds. So applying everything live. Okay. Now I would be showing you a perfect setup on a Monday, and then we take a trade. Now, if you want to watch me take a trade live, all you have to do is watch my next stream, which is in like 9 days, okay? We're moving to the giveaway, by the way, now, guys. The giveaway is almost here, but as I said, I'm live every single day, usually, from the 21st onwards, okay? And that's where you can watch my past ones as well. That's where I apply all this live. But, yeah, so what we're going to do is we're going to just bring it all together here. So the bias here, okay? We're going to be doing excuse me. Trade now, okay. So, I think I wrote this twice. Bringing it together, okay? So now we're going to be working on the bias. Okay. Okay, so this isn't just the bias. We're going to be looking at the actual trade. So bringing it all together, okay? So the bias here on the daily time frame is looking slightly bullish, okay? Because we've got to come back. This is the exact example we looked at the start. We've got to come back into this imbalance over here, okay? Now we go to the 4-hour time frame and we go, let's look at the 4-hour. So what's the 4-hour done? The 4-hour has swept this liquidity here, left behind an imbalance. And so far, it has seemingly respected this imbalance. So what might happen is we might come down, take out this low over here, before eventually actually coming over here, okay? So the daily's saying bullish, the 4-hour is saying bearish, which means we're slightly mixed, which means we can trade in either direction, okay? So the daily, bullish, 4-hour, looking bearish, and what might happen is we might come all the way down here and then come back up and come back to that imbalance and then do what we need to do past that point. So for the next few sessions, we're looking slightly bearish, okay? And for the daily, we're looking bullish back up to this imbalance, okay? So we use that bias. We go, well, we're slightly mixed, but more recently, we're looking bearish. We then go to the 1-hour time frame, see what's going on there, and we see we've just took out a 1-hour high over here, which aligns with that bearish bias. Plus, we have a nice AMD cycle playing out right here. So it looks like we might be able to target this low. Now we go to the 5-minute, which is my entry time frame, okay? And we go, well, we missed an entry. There's one right here. But I think we'd want to take this one. So we go, well, we just took out this high right here. We could have entered here. Like right here. But if you remember something from the first and second lecture, you want to focus on unmitigated fair value gaps. If there's an unmitigated imbalance before our entry or near our entry, you don't necessarily want to take that, okay? So we get in here, okay? We put our stops a little bit above this imbalance right here, okay? Because we got it above this liquidity and above this liquidity right here. Now we can target this low all the way down here. We've had nice price action leading up to this. Then we push right up. And it looks like we're going to push down now, okay? We could even try and target this low all the way over here if we really wanted to. But we want to focus on the swing level of this 5-minute time frame, okay? So we just followed it step by step. And there we go, okay? We had the right time to trade, which was half one, okay? Half one. We had the mixed bias, which was looking slightly bearish for the next few hours. We then had the 1 hour, which aligned with the structure, or with the 4 hour. Then we had the 5 minute, perfect price action, perfect IFUG setup. You take it, and then it pushes all the way down. Now, if you want to see me applying this on the charts live, I am live, back live again on Tuesday next week, which is the 21st of January. But now it's time to talk about the key takeaways, and then we're moving on to the giveaway, okay, guys? So that was very quickly just that in action, okay? I just don't want to move. I don't want to move too quickly here. That was that in action, okay? The plan you should have written down right now, that is that in action, okay? So, the key takeaways from all of this is that liquidity drives market movement. AMD reveals institutional manipulation. Daily bias ties everything together for precision. And psychology is the foundation of your consistency, okay? So, now we're doing the giveaway. Okay, guys. It's giveaway time now, okay? Right, let's see how many likes are on this stream, okay?
Playing from Josh's iPhone 3.
I'm still still connected to Alexa. Right. Okay. 95 likes, guys. Let's get these likes to 100 likes. Let's get it to 100 likes, and then we're going to start this giveaway, okay, guys? A 100 likes. 4 more likes. Come on, guys. I know for a fact not everyone here has liked this stream yet. When we get to 100 likes, guys. 4 more likes, and then we're going to do the giveaway, okay? Let's get it, guys. Come on. 4 more likes. If you haven't liked the stream yet, go down and like it. I know for a fact. Oh, my days. There we go. 104 likes. That was quick. Nice. Okay, so W in the chat if you've learned something new, okay, guys? I'm about to announce the giveaway, but that's the end of all the market outlook. Sorry, not the market outlook. Sorry, my bad. That is the end of all this mastermind. These 3 lectures have come down to this very point. We're about to do the biggest giveaway I've ever done. Okay, all we need to do now is W's in the chat if you've learned something new, okay, guys? You know the score. W in the chat if you've learned something new today. Oh my days, this is crazy. W's in the chat, guys. This is crazy. W's, okay. Now, the giveaway, okay? It's bigger than a 50k, bigger than 100k, bigger than 200k. I've had a lot of requests for this, and it revolves around the rebuild, okay? As you guys know, I'm doing a complete rebuild on the course. The course is getting rebuilt. There's new features getting in. The course teaches you everything here. There's more things to this. It's not just this, but it teaches you everything you need to know. Then there's also the psychology, everything about psychology. There's also teaching you exactly how to get funded, okay? Step by step to a funded account. We also teach you how to do trade management and how to backtest. That's the new content coming in the rebuild of the course, okay? Now, there's also new features where all course members will get pre-New York streams. If you've watched my New York streams, you know that everyone here, or everyone on the stream, sorry, gets it for free. Everyone in the course is going to be watching the stream beforehand. So we do the stream 30 minutes before the actual stream starts. So 30 minutes before the free stream, premium members get a private stream, okay? There's also monthly webinars where we do actual content. There used to be weekly lectures, but we've changed it to monthly webinars now. There's also bi-weekly Q&A calls. So every 2 weeks, the whole group in the Fast Track Trading course will hop on a call and take turns asking questions to me on a call. Group call, everyone can talk, we all ask questions. So the new features are a massive upgrade to the course, new format of learning, new lectures, new modules, everything. Pre-New York streams, Q&As, monthly webinars, okay? And this ties into the giveaway. So to give back to you guys, because this has been absolutely mental. The hype for these streams, the views on these streams, the reactions to the streams, the results that people have been getting from the streams alone has been absolutely crazy. The support for the streams has been absolutely mental. Keep the W's coming, guys. So I wanted to give back to everyone, okay? Every single person has the chance now to make $150, okay? Every single person can make $150, okay? And all you need to do, okay, all it revolves around is this giveaway. So this giveaway is basically going to be giving you $150. Everyone can win. And all you need to do is just keep watching, because I'm about to announce it, okay, guys? But that's what's in the rebuild, okay? There's so much new stuff in the rebuild. So that is the end of this mastermind, okay? If you want to learn more, head to the first link in the description, which teaches you exactly how to trade like this with a massive group of over 9,000 other members. I'll see you there.